Yeah, but you can't get on the Wi-Fi here because of the,
Yep.
yeah. All right. I
Jackie,
was,
do you know where the power cord for the extension that I had? I know it's not the time to ask you for that.
the power cord for the
I have
extension,
the-
are you talking about this right here?
Yeah,
And then the power cord that goes with it?
yeah,
The one that like,
power cord for that. Can you get that? That's what I need.
thanks, Lee.
Okay.
That's pretty powerful.
I just found what I needed and then I got distracted and I lost what I needed. So where is it? Where is it? Where is it? I think I did sent by. Look at you here. Who's in here with us? Maybe it was in here, that's why. Yep. Ay, ay, ay. Oh, why did I close that? No, I hate when that happens. Hello, Nicole. You made it. I don't see you, Nicole. You there?
Yeah, I'm here.
Okay, good.
I didn't, is it just me and you, or is there going to be more people?
Cheyenne's here, but live in person.
Well,
Oh, okay. Okay. Okay.
He'd prefer to be in person. So I said, you can be here because I'm not going to do this at home. There's no way. So
Yeah.
I said, you can come
I
hang out with.
can't see you. It just has like palm trees.
Oh, just give me 1 second there. Oh, 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 oopsies.
So I was thinking no one was on yet. I was like, oh, it hasn't started yet. There you go.
Yeah. So we had 3 students test today.
Okay.
All 3 passed.
Woohoo.
Yes, that was very exciting. Also, just wanted to reaffirm, I know there was a confuzzling moment Saturday with one of the students that had said that she took the test and had experienced she felt she experienced a smart test, which I like looking back, I kind of now it's great that she did that because she reaffirmed what happens when you have anxiety. You really can't think.
Hmm. Hmm.
Right? And everything that she said in the class during the break, she ended up recanting, right? Because what she said didn't match. But the other part of it, the fact that maybe I should wait till everybody gets on, but basically the 2 students that passed today, oh, sorry, 3 students that passed today, all of them are basically saying what she said is not true. You can navigate the test. So
Yeah.
I'm so glad to hear that because I was like, wait a minute. I have never in my 23 years of teaching this class have ever had anybody challenge our test taking techniques, right? And
Right.
so
Right.
that's why I called Irma directly. I'm like, no, I know for a fact, like they haven't mentioned anything. But when you listen, this was a great example. Like if you listen to somebody that hasn't taken the test or doesn't do this for a living,
Right.
um, they may tell you some wrong information. So again, I was glad that my students that tested this morning, all of them confirmed that you can navigate the test. But they also share that because of that conversation, it did give them a bit more anxiety than they were
Mm-hmm.
used to. So, so we had both of the gentlemen that took it today. They gave some really good feedback, but they couldn't remember. And that's what typically happens after somebody passes the test. They're like, I passed. Like one
Right.
of
And
them's
that's
like,
all you care about. Yeah. You're like,
yeah.
I passed.
So I was like, hey, did I miss anything?
Mhm.
Like, all right. So this class is a little bit different setup. We're gonna go a bit slower, but we're
Okay.
not going to be going over random questions. The questions that we're gonna go over are strategic, and they're gonna be together. Does that make sense? So, for example, let's say if you were to have our textbook, everything would mirror what's in the textbook, like chapter to chapter. So like all the code and ethics will be together, all the life illustrations will be together. All the chapters are going to be at the same, will be the same. Okay. So
Right.
not jumping from annuities to Medicare to, you know,
Hmm.
policy provisions, all that. One thing that gives me pride is knowing the one that got 80%. He's like, at first he's like, Jackie, I was a bit challenged, but what ended up happening was, based upon what you said, I was able to, sorry, I'm trying to get this all working here for me. Um, Based upon what you said, I was able to get a lot right. He went through, he's like, I got all my riders right. I got all my long-term care right. I got all of my, he says 20, no, out of 40, he got 35 code and ethics right.
Oh,
He, out of
nice.
his, he went through and he was just giving me all the numbers. And I was like, that's great to hear that
Right.
he was able
Right.
to get it done. Yeah. So, based upon the questions, let me ask you this because we were kind of pivoting with the new law that changed. Um, how do you all feel doing it this way? Or would you guys rather me just go through the playbook with you? Let me ask that.
I personally feel like the playbook is really good. Um, so I could use a refresher on that. Me first, like just I like going through it. Like I've been
Yeah,
going through it, but I feel like today I
you'd
spent a lot of
rather,
time going through it. But yeah, the
you'd
more the
rather.
merrier. But if there, what are the
Yeah.
other options besides
Well,
going
let
through
me
the playbook?
see. Well, that's what I was saying. Like in the playbook, it jumps, right? It jumps from
Hmm.
here to there, everywhere, everywhere. Where this chapter, like I said, everything in chapter one is in chapter one questions, everything in chapter two is in chapter two questions. It's not jumping around from topic to topic.
Hmm.
Can you see the screen?
I can. Can you?
I can see
I
my,
cannot.
you cannot see my screen. Okay. Let
Oh no,
Hello
the
me,
again.
screen. No, I
Good to
see
see you
you.
guys.
oh, okay, you cannot see my screen. Okay. Well, that would be a small predicament. Let's try to, okay. Let me see if I can get you all to see
How'd the
my,
rest of the class turn out the other day? I was sad to have to jump early, but did you guys get through it all?
yeah, we got finished at 7:30.
Oh, wow.
Yeah, it's because we had people leave in the middle, so we kind of stopped for a minute. But we had three and the last one standing. So out of 10 of you, we had three left at the end. Um,
Nice.
so we had one leave early. Cheyenne hasn't tested yet, but I don't know if you caught the three that tested today, all of them passed.
That's what I heard. That's awesome. Good job for
Yeah,
them.
yeah. The students that were the students that were in the class, those are the ones that took the 52 hours pretty much with us.
Yeah.
So, so yeah, that was exciting. All right, can you guys see the screen now?
Hmm.
Yes.
Okay. So like I was saying, like these are all in your playbook. There's no question. You can see the different numbers. It's basically showing you like where's the numbers at, right? Which exam we're in. So I'm kind of feeling like we should leave it like this. But what it is like chapter one is chapter one. Chapter two would be all the chapter two, which is like premiums. It's by topic. But notice how this is not question number one. This is not question number two. It's basically bouncing from question to question. Um, so just reaffirming that it is in your playbook, but I feel it's better to teach it this way so that we're covering topic by topic. And if you have any questions on the topic, you can see the different questions that you're going to need to know. Like this is like the NFDS chart, which is your non-forfeiture options, your dividend options, and your settlement options. And remember I told you 20 possible questions on each one, and here they are, right? So everything I said in the class, now I'm going to show you the questions like per topic. If you guys find like this is confuzzling, I can pivot tomorrow, but let's try this first, Nicole, okay?
Okay.
And then, like I said, like,
I
see
take
how
my test tomorrow at 1 o'clock.
okay. But you were with Irma the whole
Yeah,
time,
I
right?
was with Irma. Yeah, I've been with her for
You're,
quite some time.
yeah, so you're technically taking another study group. So we're starting
Yeah,
from the top. Okay.
no
So,
worries.
yeah. So what we're going to do is we're going to go over the question, right answer, just like we did in the class. And then anything that you're like, I don't know that. Your job is to tell me, hey, Jackie, slow down, and let's go over that. Okay. So
Perfect.
this number right here should be the number in your playbook. If it's not, then I apologize, but still
You
stay in
want
the
us to follow with our playbooks?
I think it's better just to listen in and take notes,
Okay.
to be honest with you.
Okay.
So that not trying to find it in the playbook. You know what I
Yeah.
mean?
Yeah. Totally.
Is it just the three of us, or do you have other people in the classroom too, Jackie?
I have somebody in the classroom.
Okay,
Yeah. Cheyenne's in the
perfect.
class. Yeah. And Cheyenne will be with us today and tomorrow. So it'll be once Nicole passes tomorrow.
You
I'm a
got
firm.
this, Nicole.
Yeah,
Yeah, I do.
You got
That's
this.
my
now,
thinking forward attitude. I got it.
can you see the screen or is it too small? Are the questions too small for you?
No, I can see them. I don't know about the
Okay.
rest of the group.
So I can
Yeah,
just make it
I'm good.
bigger is what I was thinking like that.
Oh
I
yeah,
can make
bigger
it.
is probably a little nicer. Yeah.
And then
Perfect.
you can also zoom in on your screen. I don't know if you know that. You click on your screen, you can actually like open it and then it'll zoom open.
Okay. Yeah. This
At
is
least
good.
in our phones it does. All right, let's go ahead and first start with, again, this is chapter 1, which is basics of insurance. It's like the general insurance concepts. You're going to have 40 questions in this section here. Like I said, the student was so prepared, he ended up getting 35 out of 40. That's a huge amount, right? And everything he said was in the playbook, so it was good to know. So which of the following is a true statement regarding life insurance policies? Remember, it's a two-party contract between the insurer and the insured. Now, this is the right answer because of these choices. But in real world and in other state exam questions, it's a two-party contract between the insurer and the policyholder. Remember, in chapter 4, policyholder is the only one that has the right to make the changes in the policy. So the contract is really between the insurer and the policyholder. So then why is it the right answer for this question? That's because assuming that you are the insured on your own policy, you would be could be the policyholder and the insured. So the test maker is playing off of that. Okay. Now remember, once the insured dies, the contract does change hands between the insurer and the policyholder is now between the insurer and the beneficiary. That way, if the insurer doesn't pay the claim, then the beneficiary can sue the insurer for breach of contract for non-payment of a claim. Did you have a question? I see your hand starting to go up. You good?
So this would initiate the first payment facility payment.
Don't go there.
Different.
This is just about policies in general.
Gotcha. Okay.
Yeah, it's a two-party contract between the insurer and the policyholder.
And policyholder is basically the person purchasing the insurance.
Not necessarily. So the person who goes and buys a policy doesn't always have to be the policyholder, because the policyholder could be a trust, the policyholder could be a business.
It could be like a beneficiary that's on a different.
Don't collapse it with that either.
Okay.
The beneficiary is a beneficiary, right? And the policyholder is a policyholder. So Sean can buy a policy on his wife, right? His wife is the insured and he is the policyholder. Now, the insured does have to sign the application to give permission for the policyholder to own and control a policy on their life, state exam answer, right? Why does the insurer assign the application? To allow the policyholder to own or to allow someone else to own and control policy on their life. Make sense?
Yes.
Okay. Remember, just basics, just the basics. Don't
Hey,
overanalyze.
hey, Jackie, sorry, just so I know kind of where in the book we're at right now. You said this is the general insurance.
Can
Is
you,
this
yeah,
actually
yeah. Can you look on probably page
like in the
I don't even
60s or
know.
70s?
Let me grab a playbook real quick while we're
Okay.
chit-chatting here.
I was gonna say as we're going through these, if I can't follow it on here because they're like spread across the book, that's okay. I just was trying to pinpoint where exactly we were.
Nothing. 49. 49. Nope, it's not there either. Hold on a minute. Yeah, it's not in order.
Okay,
It's not in
that's
order
okay.
to the book.
No
Yeah,
worries.
Yeah, the questions.
it's not gonna be the question number, but you'll see it in the playbook. It's all in there.
Got it.
But yeah, so we're doing general insurance, and then you said life today, and then tomorrow is accident and health. Is that true?
Yes, we're gonna do a
Okay,
little bit of general insurance, some life and health, but we're
cool.
doing concepts, okay? So that way you can understand what will pivot, right? So just like on
Perfect.
this one, I told you the whole story, like you need to know the concept because yeah, this is one question, but there's several different questions on this concept.
Right.
So just to reiterate, there's 1,500 in the bank and you're getting 150 plus these new 10 that they're providing you, not 165,
Sure.
10 questions that are extra. All right.
Okay.
Loss retention seems to be a popular one on the test. Words mean what they say. Loss retention is retaining the loss, right? So a loss retention is effective risk management technique when all the following conditions exist except the probability of a loss is unknown. We saw this one yesterday. Remember, if you do not know what the probability of a loss is, it's probably better for you to transfer that risk versus retaining that risk. So in class, we teach the acronym STAR, STRR. Do you see that right here? STAR stands for the 5 ways of managing risk. That's the acronym. So the concept piece there is this. The insurance company is going to manage their risk in several different ways. We also manage risk, right? S stands for they share the risk. So concept piece here is that when, let's say you have a client that wants 10 million of insurance, the insurance company's loss retention is, let's say, I'm sorry, loss retention, that their retention limit, excuse me, what they're able to retain on their books, let's say is only 5 million. Are you going to send your client away that wants 10 million? Absolutely not, right? What do? You go to your manager is going to find a reinsurer that can insure that top 5 million. It's all happening in the background. The client has no clue this is going on, but they decide that they're going to share the risk with the reinsurer. That reinsurer that is the one that's going to take on that risk. Again, the client has no clue they exist. When the client has a loss, they submit a claim. Your insurance company is going to pay the claim, and then your insurance company will submit a claim to the reinsurer. Make sense? So concept piece here on reinsurance, there's 2 types of reinsurance contracts. One's called treaty reinsurance. What's a treaty, Sean?
A treaty is like I can't give you the exact definition, but a treaty is like something that needs to be abided by, right? Like a rule,
Well, it's just an agreement,
an
right?
agreement. Exactly.
Come
That's
together
it.
on something.
So there's an agreement in place where no matter what clients I bring to the table, that reinsurer will cover all of my clients. That's called treaty reinsurance. Facultative, the root word inside facultative is to facilitate. For each client I have to facilitate a contract with the reinsurer. That's called facultative. Okay, so when you see that on your test, you have to know the difference between those two. That all falls under reinsurance, which falls under sharing the risk. Yes.
And the agent is responsible for,
The agent notifies the manager, and the managing general agent is the one that's responsible to negotiate reinsurance.
God, brokers don't do that. It's something different.
Yeah, don't collapse it with brokers. Brokers is on the property and casualty side.
Okay, different role.
Yeah, we're life agents.
Okay.
T is for transferring risk. Transferring risk, what I want you to remember is buying insurance or suing the other party at fault. Okay? Make sense?
Yeah.
The other distinction there, and just bear with me, I'm going to change frames. I don't want to confuse you all, but I want to show you a fast way. Did we show you this yesterday on where to locate the boards?
Oh yeah.
On
Okay,
Facebook.
good. Yeah, on Facebook. It's going to go to my website soon, but for now it's just here. If you don't mind following, that'd be great. It's a great way to pay it forward. Let's see here. So if we go, this is where you want to access the information. When you see star, which is going to be a big, where is it at on this board? I think I put it in the code and ethics boards actually.
I think it was almost down.
You saw star?
All of
No, that was self-funded. Yeah. All right, let's go back to the other album here. All right, here's star for sure. All right, there you go. So remember, sharing, your mom taught you sharing is caring, right? The purpose of reinsurance is to expand the capacity of the ceding insurer being the insurance company that you work for. The reinsurer is the insurance company that's reinsuring the risk. Okay. There's that retention limit that we talked about. Transferring the risk, once again, transferring the risk we said is buying insurance or suing the other party at fault. A is for avoiding. I always joke around, we say guys are good at this, right? When you're trying to avoid getting into a relationship, you walk into the bar, you see that lady, you just kind of walk around her, you don't even give her any attention. Why? Because you're avoiding the risk of getting involved with the Now, the way insurance companies avoid risk is they decline or reject applications. On your state exam, we saw this question on Saturday where it said all the following are examples of avoiding risk except, and the answer is you realize your driving capabilities are decreasing with age, so you buy more liability protection. You're buying insurance, right? Or you buy more liability protection because you realize your driving capabilities are decreasing with age. Or they'll say the purchase of an insurance policy by a consumer is risk, semicolon, and the answer is transfer. So this chart right here, you definitely have to know what STAR stands for. Again, avoiding, we saw on the question, all the following are avoiding except, and the other three choices was you don't fly in airplanes, you don't drive at night, and you return your pet tiger to the zoo. Okay. Under reduction, when you reduce risk, for state exam purposes, your examples are wearing a seatbelt, not smoking, going to the gym, having that healthy lifestyle. Under the other R, retention, it's not buying insurance. Also, what I believe, because for state exam purposes, you have to understand the distinctions of cost sharing provisions. I believe that cost sharing provisions is a form of retaining risk. Now let's go back to our question over here, because remember, when I choose my deductible or my co-insurance or my co-payment, I've decided the worst possible loss is not serious. If I go and I pay $25 every time I go see the doctor, that's not too bad, right? Losses are highly predictable. Yeah, because I know what my stop loss limit is, my out-of-pocket maximum is. So I'm going to assume those losses. But if I don't know what the losses are, it's not a good idea to retain that risk. Does that make sense?
Yeah.
And that's again, a distinction you want to remember there. All that for that, yeah, because again, it's the concept, right, of managing risk, the 5 ways of managing risk. Sometimes they'll even ask you, the A in STAR, it means what? So you have to know this acronym, okay? All right. Scrolling back down to the next question. Life insurance policy is unilateral because only the insurance company must live up to its side of the agreement. Do you remember we talked about this yesterday? Or I keep on saying yesterday, but it was Saturday. Sean, do you remember talking about this?
Yep.
Yeah, there's special characteristics inside insurance contracts that don't exist in other contracts. For example, in real estate, if I sell my house, that's bilateral, right? Both parties must perform. The seller must give that house up and the buyer better give some money, right? Or it's a family situation, they say love and affection, but that's TMI. In insurance, it's unilateral. We talked about that 16-year-old, right? The 16-year-old nearest birthday rule means that 16-year-old can buy insurance if they're 15, 6 months and 1 day. But why we said it's because it's unilateral. Only the insurance company would be forced to perform to the contract terms, not the client. If you want to cancel that policy, Sean, they're just going to let you and not pay anymore. They're just going to cancel it. They can't sue you for canceling the contract. Does that make sense?
Sure. Yep.
Yeah.
And since we're here anyway, let's talk about the other characteristics, like insurance contracts are personal contracts. It's between the policyholder and the insurer, which is really good because guess what? Nobody knows it exists, just you, the insurance company, and the agent that sold it to you, and anybody else that you tell. They're conditional contracts, which in chapter 4, we're going to go over all the conditions inside the contracts. Then we have this special characteristic called adhesion. Sean, do you know what the adhesion means?
Explain it to me because it's one of the words that I keep getting confused.
And definitely on your state exam. So what do you see as a root word inside adhesion?
Adhesion?
Adhere,
Adhere?
right?
Okay.
I'm going to adhere to something. In these insurance contracts, you got to remember the only person that has control over the wording is the insurance company. They have attorneys that have drawn up these contracts because remember, insurance is a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or unknown event, whether past, present, or future. But the only person that has a right to write that contract is the insurer. If you see something in the policy, Sean, and you don't like it, you can't put a line through it, correct what you want, initial it and date it, and now that becomes what is. No, not like in real estate, you can do that. Not in insurance. The only person that has control over the wording is the insurer. So if there's anything that's ambiguous or unclear, okay, so they wrote that contract and it leads you to believe, Sean, that you're covered, but you're not. Uh-oh. Guess who's in trouble? Not you, the insurer. Because it is a contract of adhesion, it's a take it or leave it situation. If it led you to believe that you were covered because it was unclear wording or ambiguous, the courts will rule in your favor. New state exam answer. They'll rule against the insurer. So remember we talked about dancing in the conversation? You got to dance here. Okay?
Yep.
Got to dance. All right, aleatory. What the heck is aleatory? Aleatory really means there's an uncertainty in the exchange of value because it's based upon a future unknown event. Therefore, one thing that you want to remember for state exam purposes is it's never equal. Never equal. Okay? And the example I gave on Saturday, remember, was I sell you a 20-year term policy for $1 million. The premium is $1,000 a year. You die after 2 years. Nicole, how much did you pay in premiums?
You said again, you said
20-year term policy,
uh-huh.
$1,000 a year is a premium.
Uh-huh.
$1 million is the death benefit. How much did you pay in premiums if you die after 2 years?
if you die after the 2 years, you
Yes,
paid
$2,000.
$1,000, 2,000, oh, $1,000 a year. Okay. Now I was thinking I was trying to break that down by 12 months. $1,000 per year.
So I paid two
2,000.
2,000, 2 years. How much did your family get for your untimely death?
The $1 million.
Yeah. So is it equal?
No.
No. Now pretend that you didn't die and on year 21 you died. How much did you pay in premiums for that 20-year term?
You paid 3,000.
No, 20 years times 1,000 is 20,000, right?
Oh, times that. Okay, 20. I thought you were saying 21 years old or something.
No, you died at 20, you died after 20 on the 21th year.
Oh, okay. Yeah,
Sold
21,000.
you- But I sold you a 20-year term policy. So after
Would it pay
20
that?
years, the policy
You paid
dies, right?
20,000. Right.
So how much did your family get for your untimely death?
$1 million. Oh,
Zero.
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 Zero. Nada. Why? You didn't die in time.
Oh,
I
20
sold you
years. You didn't die in
20 years.
time. Got it.
Exactly. So your
Yeah.
family gets zero. So is it a gamble? Yeah, it's a gamble. Can they pay
Mhm.
more than what you paid? Yeah. Can they pay nothing? Yeah. That's what Alatori is saying. There's an uncertainty in exchange of value because we don't know when you're going to die, right? Does that make sense?
Yeah.
So for sake exam purposes, there's two questions about this. One, the definition, where you have to know it's the uncertainty in the exchange of value. The second question is all the following is true except the insurer and the insured pay an equal amount. So keeping that top of mind, we joke around and we say, think of it this way. Ali and Tori are twins. And I know you have kids, Sean, but come on, the truth is you never treat them equally, right?
Probably not.
You have your favorite, huh?
Depends
They're
what
not
day it
random,
is.
right? They're not random.
That also changes, so.
Day to day. Who's acting up, huh? All right. So aleatory is really important to remember for state exam as well. All of these will be on your test. The last one is utmost good faith. The keywords for that one is I rely on what you say and you rely on what I say. So as we hit a board, what do you guys think? You like me going over the board real quick to kind of go over the concept piece? Then we'll see the
I
question.
like this right now. The way you're doing this, like going from here, if we get stuck on something, going to the boards is good.
Awesome. So you got to remember, because look at this. Remember, only the insurance company. So one person, right? Unilateral, only one person. Who's the person? The insurance company. All right. Sometimes, again, they'll just give you the only one party is forced to perform to the contract's terms. Yeah. All right, let's look at the next one. In regards to representation or warranty, materiality should say, material translates into which of the following? Important enough to influence the decision to enter into a contract. So in regards to materiality, if it puts the client or could put the client into a disadvantage, then it has to be disclosed. If it doesn't, like your race, right? Marital status, that is considered immaterial. It's not important enough to determine the disadvantage of the contract. Does that make sense?
Yeah.
All right, so that's an easy one. All right. Life insurance policies require insurable interest to exist. And the answer is at the issuance of the policy. Now let's go into the concept piece in regards to insurable interest. So where's insurable interest? Here it is. Remember, insurance companies are looking for an ideally insurable risk. What would be an ideally insurable risk? Something that's uncertain due to chance and accidental, and it cannot be catastrophic. Whenever you see these equals with a line through it, that's a heads up that it's an accept question on the test. So again, it cannot be catastrophic. Now, they also want to ensure that we protect indemnity, because remember, indemnity is to restore you in whole or in part to the financial condition that existed prior to the loss without gain or profit. So if you had no insurable interest, you would be making a profit, yes? Sean trying to buy a policy on Nicole, you just met her. No way, right? They're not going to let you do that. But Sean, if you try to buy a policy on your wife, of course you have insurable interest. Now, you have to also know the definition of insurable interest, and the definition is the interest in the safety or preservation of the life or the property that's being insured. The way to prove that is love, blood, or money. Another acronym they use in the test is financial, emotional, or economic interest in the safety or preservation of the life or property being insured. Sometimes you have to know the definition. Sometimes they'll say all of the following have insurable interest except, and it's neighbors on each other, employee to employer. Those are two right answers if it's an except. And then sometimes it asks you, when does it have to exist? So in this question that we just saw, in life insurance, it only has to exist one time at time of application. On your state exam, if it doesn't say the word life in it, remember general insurance concepts, that means they can test you on the property and casualty side. If it just says in insurance, don't get confuzzled. You have to pick two times, at time of purchase and at time of loss. Make sense?
Yep.
So Cheyenne sells his boat to Sean. Sean gets so excited when he gets this ski boat that he decides he's going to take it out. He forgot to call his insurance company and add the boat to his policy. And he was out there messing around, and he actually ended up hitting the dock. Now, unfortunately, because it's not insured, there's damage to, he's okay, Sean's okay, he didn't get hurt, but there's damage to the dock and damage to the boat. My friend Cheyenne forgot to call his insurance company to let them know that he sold the boat. Can Cheyenne then put a claim against his policy to help Sean out?
No, he forgot to tell. No, yeah, he can't because he sold it to him.
He sold it to him, so he no longer has insurable interest on that boat. So sorry, Sean, you're SOL. Sadly, out of luck. You have to pay for all those damages out of pocket.
Got it.
Right? Now, our friend Cheyenne, even though he didn't call him in time to remove the boat, he would be able to get money back for those days or weeks when he finally figured out he'd been paying premium still.
One more time, I'd be able to get money back.
Yeah,
even after-
because you lost insurable interest, not lost, but you gave up insurable interest when you sold your boat. So since you sold your boat, it's not yours anymore. So the liability for the insurance company to pay a claim ended when you sold your boat. So you can go back and ask for your premiums back. Now, in real life, I probably should be covering real life, but for real life, they'll be like, oh yeah, we'll give you 30 days. Let's say it's been 6 months. You legally can ask them for the 6 months.
That's crazy.
Why? Because of insurable interest. That has to be present, and you didn't have the boat. So you had no insurable interest on the boat.
I would think, like, if you're already paying them and it's something you're paying for, but it would make sense though, now that you're saying it, because if I'm just buying into the idea of it being insured under my name, but it ends up not fully being under litigiously, it's no longer
Yeah.
under my name.
Exactly.
I still can get the refund and collect the money that was going into the idea of saving the property of the thing I was putting money into.
Yeah. Don't overthink it, but yeah, it's real life. So does everybody understand insurable interest?
Yep. Really
So we're
quick on
gonna
that. So like if that situation like would go to court, they would look at the transaction timeline of like when the sale went through and then said, yeah, this happened after that. Mistake for you not calling it in, but Sean actually would have needed to get insurance on the boat.
Yeah, and by him doing that, it's actually fraud. So he would get in
Got
trouble
it.
for fraud. He doesn't want to do that in real life, right?
Yeah.
So the Department of Insurance says that insurance company has to pay him, no problem, but you cannot submit a claim on his policy because it's not his boat.
Okay.
All right, so in life, this is saying life policy. So this is how you know the answer is not 2 times, okay? It's not when loss occurs and at time of purchase. It's only at the time of purchase. Now, Sean, I've said it a lot last week on Saturday. I said words mean what they say, but most importantly, dance in the conversation. The new way they're saying this is at time of inception. But this old question is still in the bank. So because they're like recycling questions right now, even the students that took the test today, they were able to pass. Why? Because it doesn't matter. If you understand the concept, it doesn't matter how they ask it. You're going to be able to figure it out. Make sense?
Yep.
But you got to remain calm. That's the key. Got to remain calm. All right. Which of these defines the principle of indemnity? An insured cannot receive more than an actual economic loss in the event of a claim. Yeah, we just talked about that. We said indemnity, the key word is to restore you in whole or in part to the financial condition that existed prior to the loss without gain or profit. All right. In life insurance, the only measure of liability is what? What did you sell the client? So it's the amount payable as provided in the policy or policies. Going back to this board, under ideally insurable risk, it's not on the board and it should be. It's uncertain due to chance, accidental, and it must be measurable. Well, how do they measure liability in life? Right here, as payable in the policies or policy, okay? Or the amount payable as provided in the policy or policies. In insurance, again, why am I saying in insurance? Because if they take out this little 4-letter word, it changes. Why would they ask you that? Because in the health, when you have a health policy, how do they cover your loss in health insurance? Based upon your losses. Just because I bought a policy, what's that?
Went to the restroom. I'll be right back.
Okay. Thank you for letting me know. Don't take your phone with you.
So the acronym OCRAP would be applied to life insurance?
Oh, we're gonna go back. Don't jump ahead too much. You're jumping into chapter 4.
Gotcha.
Stay with me here. All right, any questions on the measure of liability in insurance? So the measure of liability in insurance is simply based upon the losses and the coverages that you have. If you're not covered, then you're not going to cover everything, obviously. All right, facing a personal risk of loss and holding a lawful and substantial economic interest in the subject of insurance is the definition of the following. And the answer is?
Insurable.
Yeah, let's all say the answer together. I think that creates you saying it. And I'm a strong believer that if you say it, you're engaged in the conversation. But most importantly, when you say it, you own it, it's yours. So altogether, the answer is?
Insurable interest.
Thank you. And again, if I'm going too fast, because I'm gonna start speeding up a bit, let me know and I'll slow down. So if you need me to explain something, okay, I will definitely do that. Now, the law of large numbers, this one's an easy one because kind of helps you right here, look, understand how premiums are determined. So which statement relates to the law of large numbers?
The larger the
The
number.
larger number of separate risks of a like nature combined into one group, the more certainty there is to the amount of loss in a given period.
Awesome. So when you see the word law of large number, okay, it's a statistical rule that says the larger the number, the more accurate the prediction. So if they can predict losses, then they're able to set appropriate premiums. So I kind of like my law of large numbers board because again, we saw one version of the question, but there's more versions of that question, concept piece, right? So the law of large numbers, the moment you see the mathematical equation that states the larger the number of similar exposure units, the more accurate the prediction. Therefore, the insurance company can protect their losses and set appropriate premiums. Okay. Now, the other piece to this is who does this? Who is the person that, determines the premiums?
Adjuster.
The actuaries.
Different.
The actuaries are the brains behind it all. They're the ones that have looked at the law of large numbers and studied the tables to determine, based upon the projected losses, how much they should charge. Make sense?
Mhm.
So they determine the premium rate. What is a premium rate?
Percentage of paying annually.
The rate that you pay per unit of coverage. What's one unit of coverage? $1,000. All right, code and ethics here. What age is considered an elder in California?
65.
Thank you. I'm not sure why it turned to yellow, but we're gonna go with it. A type of short-term insurance is what?
Travel insurance.
Travel
So
insurance.
again, you heard me say words mean what they say. When you're traveling, usually it's for a short term, right?
Yeah.
So we can connect it that way. Who's the least likely to sell travel accident insurance? And that's us, the professional life agent. We're not going to spend our time on these. They're very low commissions. But travel
Get
insurance,
that through the travel company, right?
yep, let them have it. We don't want that. All right, looks like we got a bit of, oh, that's why it's yellow. It's not in the right place. All right, which of the following would not be covered under disability insurance, but may be covered under long-term care? Alzheimer's.
Alzheimer's.
All right, let's go back to some general insurance concepts here. All the following would be considered one of the three major types of losses except,
Financial loss exposure.
Sean, you didn't get the acronym page, huh? Did
I
you?
did not. However, I did chat GPT common acronyms in the life test or the life health and accident test, and it gave me a bunch. But if you have like a cheat sheet, I would appreciate it.
Well, tell me, what did chat tell you? You have to send that to me.
The
Can you
long list.
can you send me a text right now?
Yes. Do you want to put it in the chat or is this
I'll just
recorded?
say
Can
it
you
out
just say your
loud.
number?
That's 408-685-6797.
All right.
Wow. My student this morning got an 88%.
Nice.
80 and then 88. Yeah, that's good. I won't tell you what the other student got, but she did good. I mean, considering what she was dealing with in real world. All right. Did you send it to me yet?
I'm highlighting it right now and then I will text it to you.
All right. Probably won't look as pretty. Nicole, are you done yet using the restroom? No? Okay. I went to my iCloud account. If the picture's kind of wonky, let me know.
Here, I'm actually typing your number right now. 8685. All right, just sent it.
No, it says master. Oh, there it is.
So
I'm all
just yeah,
no.
if you click on that, it breaks it out by like life insurance, health and accident.
Okay, you tell me if it's the same. So what I'm giving you, and we do just ask that you don't share with anybody because that's how we want to keep our doors open and help out
Yeah,
more
of
people.
course.
Just trash it when you're done. But there's 2 on one page, and then there's the acronym list. So the 2 on one page is the number sheet.
Okay,
So yeah,
perfect.
is it more or less than what you got on yours?
I like yours better because it's actually kind of like breaks down the explanation of it too.
Yeah, a little bit. Yeah, for sure. All right.
Cool.
I think we lost Nicole somewhere. Hopefully she comes back. Now looking at that acronym sheet that I just sent you, Sean, though, what does the
Yeah.
first one say on the upper left side? What does it say?
PLH,
Yeah, what did it say there?
property loss, liability loss, human loss, insurable risk.
What's missing?
Financial loss.
I'm back. I'm just kind of trying to get set up differently because I was sitting right next to the heater too, and the heater was putting me to sleep. So I was like, I grabbed me a Red Bull
You know, it's
and I
funny
cut
because
the,
I just
and I
ran to
cut
get
the
me
heater off, and my face is like turning red.
and I just ran to get me a coffee. Sorry, Sean. I was putting Sean on blast.
Not even.
Nicole, you can text me real quick. I can send you what I just sent Sean.
Let me grab my phone.
All right. So notice how financial loss is not one of the three. Did you
Yep.
see that?
Yep.
So again, that's how we're helping you remember. Financial loss would be too general. It would include the losses from the state lottery, investments, and gambling. And speculative risk is not covered. Therefore, that's why we can't pick loss exposure. Does that make sense?
Yeah.
Loss
Yep.
exposure, a financial loss would incorporate if you got any type of losses through the gambling, through investments, or through state lottery.
Property.
What's
So
your phone number?
408 685 6797. Does that make sense?
Losses
Six.
really
It does.
685
not like life, because life insurance. You
one
can't
four
really
zero
make-
eight 685.
Well, that's, I'm sorry, 408 408 685 6797. Did you catch that 67 in there? 6797. Nicole, you know what 67 is?
87.
Oh, you got it.
Okay,
My grandson's 14, so he taught me that one.
got it. Did you
All
get
right.
my text?
Let me just take a peek. Yep, I got it.
Let me see that.
All right. So
Okay.
Nicole, I don't know if you heard me talking when we were doing all this, but we do ask that you don't share this with anybody so we can keep our doors open here at Quick
For
Learning School.
sure.
Okay, so just delete it once you're done, but there's a lot of content there to help you, the number sheet and then the acronym list. So we were on the first one because the first one talks about the 3 types of losses covered in insurance. So that's exactly this question right here. All the following would be considered the 3 major types of losses, loss exposure to accept, and the answer is financial loss because like I said, under speculative risk, we don't insure those types of losses. Financial loss would incorporate that, and so we don't. So that's why it's an accept, and that's why it's the
Okay.
answer. It's too broad. See
Okay,
that? All
yeah.
right. Now, have you been studying your playbook?
Me?
Everybody.
Yes.
I have, but not enough. Like I'm taking my test a week from today, so
Yeah.
I am studying it, but like I got to get really deep on it this week.
So do me a favor. You know what? Don't do me a favor. I'm going to send you all that update that we talked about, but I want you to see it like the day before you take your test.
Okay.
So last night, because Galen, you remember, Galen had to leave. So I'm like, you know what? I need Galen to pass. We have a big contract on the line with the 3 of them. So I'm like, no, I need Galen to pass. So I sent her the updated. So these were like the different ways that they asked the same questions. I see things already in the class, but we're not doing the whole class together. We're only doing, this playbook. And what I want you to give you the option to do is to be able to ask questions. But like I said, we're going to go through as many of these key points as we can to get you ready so you can pass. When you go through your playbook, it's going to be, again, the repetition. Then you can see, okay, these are commonly asked questions as well. All right. So back to what we were talking about, the financial loss. Okay.
Yeah.
All right. The likelihood of incurring disease or disability at any time is morbidity. Sorry,
Morbidity.
altogether. The key word for mortality is
Death.
death. Good job. Did you know we have a 3 times greater chance of becoming disabled by 65 than dying?
Unbelievable.
Isn't that a crazy statistic?
Yeah, that is.
Yeah. And nobody buys disability policies. I shouldn't say nobody. A lot of people don't. All right. As an employer, this sudden and untimely death of a key employee is considered what type of exposure?
Personnel loss.
Now, remember, what's the difference between personnel and personal loss?
Personal is like
careful.
affecting
Personnel is
yourself.
like-
Yeah.
Oh,
Yeah.
one at a time. One at
Go
a
for it.
time.
You take it, Sean.
We were probably going to say the same thing, right? Like personal, it affects me personally, myself, whereas personnel is employees in the organization.
Yeah.
Well, I want you to be even more careful to that because what happens is you're right, but you're right, but really I want you to pay close attention to how it ends. You see, I'm trying to do something up here, not working. Why do I want you to see how it ends? Because if it says, oops, that did not do what I wanted to do. The NEL is different than the AL. Yeah.
Right.
But oh crap, when emotion goes up, what happens?
Intelligence goes down.
And we just jump to the wrong conclusion, right?
Right.
And we
Yeah.
don't see the extra data there. The verbiage changes in our mind. So you have to make sure that you remember this is a right answer for a business employer, personal loss is also a right answer when it talks about, maybe Nicole buying life insurance on her husband. That would be a personal loss exposure that she's protecting herself from.
Yeah.
Make sense?
Yep.
The words truly do mean what they say. Okay. If we keep it simple, you can definitely work those out and get those easy peasy questions out of the way. Another one that likes to trick us is this one, moral versus morale. There's 4 types of hazards that you need to know about. The 4 types of hazards. See if I can get to the, Jackie. All right, sorry about that. Push the button too fast. All right, here we go. Where's my hazard board? Watch it be in the other set. Of course it is. Oh, here it is. All right. All right answers for a different question. So you have to remember the keyword. So a hazard is anything that would increase the chance of a loss. Does that make sense? Anything.
Mhm.
Yeah.
If it's a physical hazard, though, it has to do with anything that would contribute to being physically, right, a challenge. So if you live too close to an explosive factory, proximity to that explosive factory increases the chances of you dying too soon, especially if that explosive factory explodes, right? Now, another distinction is a defective thyroid. What the heck is a defective thyroid? You have one. Wow. Okay, well, now you know that would be, but I don't care what they say, defective heart, defective lungs, defective kidneys, whatever they add there, that'll be easy for you to dance in the conversation. Some people are like, I don't even know what a thyroid is. You don't need to know what a thyroid is. I just, remember a thyroid is a defective body part. We're not going to go into details about what it does and what it doesn't do. But it's a physical nature, right? Make sense? Is that easy?
Yep.
Where it gets hard is the moral versus morale. Because here we see, again, just like personal and personnel, we see one little letter makes a difference on the definition, right? So a moral hazard would be intentionally creating a situation to collect on a loss. Misstating your health history on an application for insurance, they could say life insurance, disability income policy insurance, doesn't matter what insurance they claim. When you misstate your health history, that increases the chances of the insurance company having a loss or having to pay on a loss sooner than expected. Make sense? So that's a moral hazard for the insurance company. Not to be confused with morale hazard. Morale, or moral with an E, is unintentional. It's having an indifferent attitude. It's being careless, known as carelessness. Examples would be driving recklessly. And another way she'll say that is driving severe bouts of speed. Now, going back to the questions over here, which of the following would be considered a morale hazard? And in this case, she says the insured drives too fast. Look at number 1. What's number 1? That's a moral hazard. So don't pick that one. What the heck is this? They're to
Physical.
try to confuse you. Yeah, physical. Yeah. Make sense?
Yeah.
Yep.
Now, sometimes I like what Laura does here because she'll put, morale is comprised of carelessness, irresponsibility, bad habits, or traits of the insured, such as worn out tires. So that's yet another way they'll say that, worn out tires. Why?
Carelessness of maintaining.
Because you're not taking care of your tires. Yeah. You're just being careless. All right. At what age is a senior citizen given that 30-day right to return?
60.
At 60 or older.
Yeah.
I'm sorry, really quick. On that whiteboard you had, it said legal, but it was crossed off. Is legal just not in the picture there at all?
So where do you see how they gave you an example of morale, physical, right?
No, he's
Yeah, it
talking
was
about on
on your
the whiteboard.
whiteboard. On your whiteboard, I saw
Yeah.
legal, so I
Okay,
was
what they like-
curious.
So what they like to do, just want to give you the heads up, right over here, it's moral, morale, physical, physical. Where's the legal? Usually they don't even ask you about legal.
Okay,
So you have to know it. That's one of the hazards, but typically they won't give you anything to about the legal hazard.
got
Make
it.
sense?
Yeah,
But legal liability, anything that, you know, anything that would increase the chance of you having a legal liability, like owning a business, right? That increases your chances of being sued.
sure.
Especially
All right, did you understand this one, the right of rescission?
Yeah.
Okay, so the right of rescission, remember senior, the moment we see senior, 60 and older.
What? Wait, what they just? Wait, go back. I want to.
It's right here.
A right to return where?
A right to return your policy to the insurance company.
Oh, return the policy. Okay, okay, okay. I'm caught up now. I got it.
And remember, look at the explanation. I love the explanation. Free look or right of rescission of 30 days is permitted for the insured individuals over age of 60,
Yeah,
right? Under 60, it's 10 days only.
right.
But it's telling you free look or right of rescission, also known as a cancellation period.
Yeah.
All right, the main master policyholder in a group health insurance contract is,
Employer sponsor.
Employer sponsor.
all right, relevant to health insurance, morbidity includes all the following except
Years employed.
Years employed.
in the cram course we showed you the one that said intelligence, right?
right.
All right. Oh, look at which of the following is a hazard? Altogether?
A
Condition
Condition
that
that might
might
increase the
increase the
likelihood of a
likelihood of a
loss
loss
occurring.
occurring.
So my key word in the answer is increase.
Increase.
Remember, this is a law of large numbers. This is cause of loss. And then, of course, chance of a gain or profit. All right answers for a different question. All right, loss retention. We saw this. Loss retention is an effective management technique when all the following conditions exist except.
The probability,
Probability of loss is unknown.
So again, repetition is always going to be on this on these playbooks. It's intentional because those are what's called core concepts, meaning we know that they're going to test you on that. Sometimes they'll just ask you about the definition of risk. So risk is,
the
Uncertainty of loss.
there's so many different ways they'll say that. Sometimes they'll say all of the following are definitions of risk except, and the answer turns into cause of loss. So be very careful. Remember, increase is a keyword for hazard, right?
Okay.
All right. Why would a large number of similar exposure units be important to insurers?
The greater the number insured, the more accurately the insurer can predict losses and therefore set appropriate premiums.
Did we talk about that when I showed you the board? So now we have two possible questions on the law of large numbers, right? Again, sometimes the question will say the mathematical rule that says blah, 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 blah. And then they're looking for law of large numbers in the answer. Okay, so this is again about the law of large numbers.
These ones are pretty self-explanatory, right? It's pretty much like the larger, the more accurate, the greater, the more accurate.
Yeah. Sometimes they'll say the law of large numbers is able to predict all the following except. And the answer is who would have a loss. They can't tell you who, just that someone will have a
Yeah.
loss. All right. Any situation that presents the possibility of a loss is known as.
Loss exposure.
Thank you. Because words mean what they say, right? And here we see it again. All the following would be considered major types of loss exposures except.
Financial loss exposure.
Everybody usually gets that one. We see this one again.
All right. I gotta plug up my laptop so I don't lose you guys. I'm here though.
Okay. What kind of coverage protects an insurance agent for losses due to professional services he or she rendered or failed to render?
Errors and omissions.
Yeah, sometimes it's an acronym format as E&O. And you got to remember that another question will say is what's a typical amount? Usually $1 million. You can buy more, but we usually buy $1 million. An insurance contract is an aleatory contract. This means,
Performance depends on an uncertain future event.
didn't we just talk about that?
Yep.
Yep.
Simple. What is a contract as one-sided?
Unilateral.
Good job. The company is relying on the truthfulness of the applicant. What's that?
Utmost faith.
Good job. And the contract is personal in nature.
That one
Personal.
is the emotional.
Personal. No, it's personal in nature because it's a personal contract.
Yeah.
Did I say words mean what they say?
Yes.
Yeah, truly do. All right, which of the following is a hazard?
A condition.
Condition that might increase the likelihood of a loss occurring.
Not wasting my time.
All right, all the following are true of insurance except?
It eliminates.
It
risk.
eliminates risk.
Okay, very important to remember that. Just because I buy life insurance is not going to eliminate me dying. We wish, but it doesn't. Right? This is word for word right here. Very
Transfers
easy.
the risk, right?
What's that?
I was just saying, like, it transfers the risk. Like, you get the insurance and it transfers the risk to somebody else.
The financial risk, but it's not going to
Financial.
eliminate me dying, right?
True.
Inevitable. The great man upstairs decides when, right? You
Yep.
can't eliminate that. I'm saying it that way to help you remember it. When you see it, just go for it.
Yep.
All right, what kind of coverage protects the insurance agent for losses due to professional service he or she rendered or failed to render? We know that's
Errors and omissions.
If it goes beyond that, it's considered insult.
the doctor. No, don't think of it that way. Say that again, though. E&O is for
Errors
if you make an error, oops, my bad, I made a mistake, or oh my gosh, I forgot to tell my client this. You omitted something.
Oh, you didn't
But
disclose.
your E&O insurance does not protect you if you defraud your clients.
The Snoopy sticker over the.
Yep. Exactly. Exactly. He said the Snoopy sticker over the life insurance words on the illustration. Sure. The doctor in utmost good faith applies to the business of transacting insurance. That's all blah, blah, blah. But which of the following is an example of utmost good faith? Of
Each
its
party
application.
is entitled to rely upon the representations of the other party.
And the key word we gave you is rely, right? I can rely on what you say and you can rely on what I say.
It's considered mutual technically, right? It's both.
That we're entering it into utmost good faith, that we're both being truthful. All right, an insurance contract is an aleatory contract. This means?
Performance depends on an uncertain future event.
Future events.
All right, in an insurance policy, the term that allows doubt in the document to be construed against the party that worded the contract is?
Adhesion.
Adhesion.
And again, you should know aleatory by now. We know unilateral. What the heck is estoppel?
Oh.
Estoppel is used, it's actually a court process that stops somebody from asserting a right that they voluntarily waived, which is known as waiver on the state exam. So if somebody voluntarily waives their right, it's called a waiver. And what stops them from reasserting that right is estoppel.
Like disclosing a HIPAA document for an employment, like you're doing a stop waiver, you're saying you could look at this from my consent, or I'm
No,
like
let me give you a
being
different example.
permissive to allow it one time for.
So you and Sean are door knocking,
Sure.
right? And when you're door knocking, somebody goes and no, this is better. This is a better one. You have a client that walks into your office. This is on the state exam. That's why I said this is better. And pays you cash.
Right.
Because they like to pay cash. So they pay you cash. They walk in the day it's due. Okay. The policy due date. The next month they pay on the last day of the grace period. Okay. The next month they pay it the day after the grace period. And you're like, it's okay. No worries. I got you. And you went and you put it into the system and the policy did not lapse. The policy stayed, right? Did not lapse. The next month, they pay you 5 days after the grace period. And you try to tell them, sorry, it's been 5 days after the grace period. Your policy is lapsed. Legally, he can stop you from asserting that right because you waived it when you allowed him to do it the last month. because what your actions
Considered fraud.
are actions of the insurer.
It's considered on his behalf, yeah,
You gave him a freebie.
Yeah.
You voluntarily waived the right of the insurance company when you kind of shouldn't have, but they can stop you from asserting that right because you did that. Make sense? It would be a court process. Most people don't even know they can do that. They're just like, oh, okay, I guess.
do agents get sued pretty commonly, like,
It's a great question for an attorney that I'm not an attorney, so I cannot solicit legal advice or even answer that because I don't know, to be honest with you. You can see on the press releases what they do go after. The insurance Department of Insurance will go after like fraud and stuff like that. They find out. Yeah. When an individual purchases insurance, he is.
Transferring the risk.
Transferring the
Thank
risk.
you. Facing a personal risk of loss and holding a lawful and substantial economic interest in the subject of insurance is a definition of what?
Insurable interest.
Thank you all together.
Insurable interest.
All right, I know there's a delay on the system. Sorry about that. Here's another way of saying the same thing. The purchase of an insurance policy may not provide one of the following for the insured. Select the most accurate answer.
Elimination of risk.
The same thing, just worded differently.
Uh-huh. And that's what I love about this playbook because it just gives you all the different ways so you're like ready. Any situation that presents the possibility of a loss is known as
A loss
A loss
Loss
exposure.
exposure.
an agent acting as an insurance agent, broker, solicitor, life agent, or bailey agent acts in which capacity when handling premiums or return of premiums?
Fiduciary.
Fiduciary.
Thank you. Let me go back a little bit smaller so we can get that. There we go. Any situation that presents the possibility of a loss is known as?
A loss.
A loss
A loss
exposure.
exposure.
All right. So that's one part of some of the wonderful code and ethics. Here's some more. This is all part of code and ethics in general insurance concepts. All right. So what is the order from lowest to highest on premium mode?
Annuals.
Annual, semi-annual, quarterly, monthly.
Monthly.
And we'll see where they flip it. Highest to lowest is,
Monthly, quarterly, and semi-annual and annual.
thank you. And we saw the other one on the other, in the cram course where they say comparing the two, which one's lowest? And that was annual to quarterly.
Semi-annual, quarterly.
All right, in insurance, the only measure, the only measure of liability is the amount of what?
Payable as
Payable as
provided in the
provided in
policy.
the policy.
And remember that you see the word life right there. It's what is paid as stated in the policy or policies. But this is another way they'll say the same thing. Choose from the following selections that best describe premium.
The amount an insured
amount
pays
insured pays
for
for
each
each
unit of
unit.
coverage, $7 for every 1,000 of coverage is an example.
Now be careful because there's another question and the answer, the way they say it, what best describes annual premium? And the answer is the fund received by the insurer from the insured to realize the benefits of the policy. Okay. Now, if it says annual premium, that's what you should say. If this says premium rate, then number 4 remains the same because that's exactly what the premium rate is. But sometimes, like in this question, they don't give you the option. They don't say premium rate. You have to assume they're asking for the premium rate. Okay.
Are 1 and 2 the exact same?
No, look at this. Funds received by the insured from an insurer.
Ah, okay, okay.
But it's tricky, right?
Uh-huh.
All right. Insurance provides all the following benefits except
It eliminates the risk.
Eliminates the risk.
always the right answer when you see it, it seems like, huh? The insurer that allows the policyholders to receive dividends when there's a profit is what type of company?
Mutual
Mutual
company.
company.
Again, all right answers for different questions. Service insurer is your medical carriers, medical carriers. Reciprocal, your keyword is unincorporated or attorney in fact. And remember, a stock company is owned by the stockholders.
Sure.
They issue non-participating policies where mutual is owned by the policyholders and the mutual insurer sells participating policies. So stock is not participating where mutual is participating. All right, let me go to my board, see if I have a board for it. And I believe I do have a board for, here it is. All right, so this is a great way to like see it visually because they love to trick you on this one. So again, stock insurers is owned by the shareholders. Those shareholders will receive a stock dividend if that company makes money. Remember, it is taxable because anytime your money makes money, Uncle Sam says he wants half. Okay, it's not really half, but it kind of feels like it, right? It's 25%. I mean, it's still,
Or
if you do short-term investing, long-term, I guess it's like only 10%, but still.
stock insurers have a, well, like mutual funds or a different thing.
Yeah, we have agents. The stock insurers have, yeah,
But
of
those are
course.
like hedge funds, right?
No. It's just like Farmers, Prudential, they're all stock insurers. Allstate, I believe, is also stock.
I don't know.
Mutual would be like your State Farm, Northwestern Mutual is a mutual insurer. New York Life is a mutual insurer. Omaha, Mutual of Omaha. Sometimes they put it in their name, like Penn Mutual, right? So remember, stock insurers owned by the shareholders or stockholders, and they will receive a stock dividend. It's taxable. The policyholders purchase non-participating policies. Another way of saying that is non-par. Whereas the mutual insurers owned by the policyholders, they'll receive a policy dividend if they purchase a participating policy. It's not taxable and never guaranteed because it's a return of excess or surplus premiums paid. The acronym to remember how they can get the dividends out of how they can request their dividends is OCRAP, which we'll see it later. If a stock company wants to become mutual, they must mutualize. If a mutual wants to become stock, they demutualize. This goes back to third grade. Do you have any kids in third grade, Sean?
Nope,
How old
not
are you?
yet.
How old are your kids?
My oldest is 5.
Okay, 3 more years when they're in third grade, they're gonna learn prefixes, right? Do you remember prefixes?
A little bit.
Yeah, whenever you
Yep.
put D in front of something, it takes it away, right?
Right.
So the only reason why I know it was third grade, Sean, is because my daughter teaches third grade.
Got it.
Otherwise, I wouldn't know. I wouldn't remember either. All right, here we have reciprocal. Remember our keywords for reciprocal insurers, attorney in fact, and unincorporated. So over here on the state exam, it'll say an insurance company managed by a board of directors elected by they could say policyholders or shareholders, and then you would answer accordingly. But if it says it's a group of unincorporated businesses that agree to insure one another and they have an attorney in fact that runs a company, that's your reciprocal. Okay? It's a group of unincorporated businesses that agree to insure one another. Not to be confused with our fraternal benefit societies like the Elks, Knights of Columbus, Lions, Lutheran Brothers.
Rotary clubs, Elks Lodge, like
Those fraternal insurers only sell to their members or the family members of their members.
that's how they make
Okay.
money.
So another way to remember that is members. Keep it simple, right? You see members, you're looking for fraternal in the answer. If you see fraternal in the question, you're looking for members in the answer. It's the only question they're going to ask you about that, if they even ask it. Because look at how many other questions they can ask you about insurers. And they only have so many questions designated to code and ethics, right? Sometimes they'll ask you like 5, 6 questions between mutual and stock. Why? Because they're banking that you didn't pay attention, right?
So
Remember what I don't want to pick on Jocelyn too much because I understand where she was coming from now. But I don't know if you noticed, my energy just shifted on Saturday when she went over and she said what she said because I was like, there's just no way. And I'm stuck in there's just no way. There's just no way. Because there is no way. You have to be able to go back and change your answers if you need to. That's what they bank on you changing your answers, in fact, right?
I took the test 5 years ago and I was like, I was able to go back. So I was so confused. I was like, this has to be something super new because I
But
just
did
it
you
didn't
miss?
even make sense, like logical.
Yeah. And the truth is insurance companies or I should say our Department of Insurance doesn't have the money to go out and pay for that. That's an expensive test, right? But despite that, I just wanted to reaffirm that when Frank and Andy and Galen called to affirm that they passed a test, they also affirmed that you can go back. So she must have had a fluke in her test or something, or her emotion was so high that she couldn't think and she didn't even see it. So just an FYI, we got the point of clarity that what she said was not accurate for the students that tested on site today. Okay.
And with
So
that being said, then the strategy of doing like
the
questions
four
30 through
rounds.
60, like we don't need to do that then, right? Just take the test normal or skip if you want.
Oh, you still want to do it that way. And the
Oh, okay.
reason, yeah, Sean, I mean, Frank got 80%, but he's like, Jackie, the first question, I was like, am I taking the right test? And I was like, oh man, because Jocelyn got in their head that he didn't skip questions, he just went straight through. So even though he used the old school way of doing it, because he was with me for 6 days, right? They
Yeah,
knew the
yeah.
content, but what really like got me was, oh my gosh, I can't believe he didn't do the process. He didn't trust the process because I had somebody contradict my process. So I just want to reaffirm the 4 round system is the way that you're going to keep your energy high in the beginning and you're going to get your confidence with the ones you know. You want to use the 4 round system. It keeps you you don't want to get parked. The
So the
moment you get parked in a
system, is
question,
that
it's
where
stuck.
the one where you, sorry, where you were talking about go through and put D on all of them?
No, you don't have to do that. That is if it's a smart test, which she claimed it was a smart test. You don't have to do that. All you got to do is go to the drop down menu where it says question number 1, right? Click on that. Scroll to 150, right? You click on 150, it'll show you question 150. That gives you the peace of mind to know that Jocelyn was wrong. Okay?
Basically, Nicole, that they're not going to like change your questions throughout. Like we were worried that if it was a
Yeah,
smart test, that it would like analyze you, and then all of a sudden, like question 30 is a whole different round of questions. So
right.
instead, but Jackie, you're still saying like start 31 through. I wrote them
Yeah.
down.
John, the psychology behind it is this. Okay, this is the psychology, and this is what, again, Frank reaffirmed. The first 5 questions on his test were so hard, he didn't even recognize the content. So that tells me right there, they win. They're doing exactly what we're saying. They're front loading hard questions to suck your energy,
Yeah.
right? So you don't want to get caught up in their game. You want to play the game to win, which is to use the 4 round system. So just to be clear, and you can practice it in your exam assessment if you want to. But remember, look at the answers first only. Click what's familiar, and then read the questions with those answers, the answer that you picked, to confirm that you got the right answer. Just to reaffirm, if you go to the One Day Cram website and you go down to this page right here, it talks about the 4 round system. Now, we used to not even say round 1 was scroll to 150. We used to say round 1 was go to 31 and start your test. But students started hearing things just like what Jocelyn did in class. They would hear it in line. Okay, they would be standing in line, they hear people talking, and they hear somebody say to the next person, "Oh, did you hear the smart test?" And then it would just continuously, like, students would come in and say, "I think I got a smart test." And it's like, "What are you talking about?" Well, because this and this. And I'm like, I knew that it wasn't at that point. But again, new year, and then Jocelyn came in with such certainty. I was like, no, that's not right. But anyway, I'm glad we got reaffirmation back to what is true. And that is there is no smart test at this time. So then why do I tell you go to 150? To give you peace of mind. Because what happened to her? She did it her own way. She took the test her own way. And what did she say? I got a question that was really hard. And as soon as she gave me that one, they gave me more of that one, right? And then I kept getting more of that one. So in her psyche, she's like, oh, they're analyzing my answers. It's a smart test. Where did she hear that it was a SMART test? Right? Where did she hear that they're
Right.
analyzing her answers? She came up with that on her own based upon her experience that she was getting harder questions. These tests, usually they have 6 exams, okay, that they're testing because they want to see the performance of the questions. If they're giving you random tests based upon like everybody's different, they can't analyze the tests that way. Does that make sense?
Yeah.
Yeah.
So there's 6 exams. Which one will you get? I don't know. But they do like to front load the hard questions. So don't start on question number 1. Go to question 31. When you start at 31, you get past those hard questions, and you get to the easier questions and more moderate questions. If 31's hard, skip it, right? Get to those easier and only answer the ones you know for sure, for sure, for sure. If you use that system of starting at question 31, you get to 160, you loop back around to 30, then you look at the bottom and it's going to tell you how many questions you have answered out of 160, how many you've answered. And if it says you've answered 100 confidently, how do you feel approaching the last 60? More confident, right?
Yeah.
And then you do round 3 where you tackle the longer scenarios with more focus, right? If you're still stuck, you skip them and you do it at the end. You do it in round 4. And when you go to round 4, this is the one where you're cleaning up, right? You're doing all the math, you're doing all the hard. And once you finish your test, you're going to know, like, when you start round 4, okay, I've got like 35 left where I really am struggling here. You're going to feel, okay, it's not a big deal because I feel confident in the front, right? The first 115, I feel very confident. So these last 35 that I have, what happens to your energy? It's not overwhelmed because you're like, I feel confident with the first part. And then you have one of the anxiety creators is time. So that when you get to round 4, you're like, I still got a whole hour and a half. I got this, right? So it's all about managing your time. So doing the 4-round system, it's really making sure that you buy time so that you at the end can handle those hard questions. But really, students Andy responded within an hour and a half from his test, if my memory serves me right, an hour and a half from his testing time. So by 2:45, I had got a text saying he passed the test already.
Great.
So what does that tell you?
Yeah, he did.
Unless he started earlier, right? But for the most part, based upon his test time, I mean, that's not bad. Makes sense? So I think it's really important to use the 4-round system just to really manage your energy because it's all about managing the energy. If you let them dictate the questions and then you let them suck your energy, that's where the easy questions become hard because you're approaching them under anxiety. Emotion gets high. Yeah. Make sense?
Yep.
All right. Thank you. All right. So Lloyd's of London Syndicate is another way they'll say that, Lloyd's Syndicate. So the question will say all the following are under the jurisdiction of the California Department of Insurance except Lloyd's of London because it's a syndicate similar to the New York Stock Exchange, and then Medicare because Medicare is federal. And then the one that we saw first question on Saturday, LASIK. Why LASIK? Cosmetic.
Yeah.
There's 4 departments inside the insurance companies that the state wants you to know about, but in real life, there's so many more. M is for the marketing department. Their job is to identify prospective clients. Once you identify them, your job is to take the application and give it to the underwriter because the underwriter's job is to underwrite the risk. And distinction here is selection, classification, distribution, and rating of risks. Their job is to protect the insurance company from adverse selection, which is high risk, somebody that's just been diagnosed with a terminal illness, right? They're extremely high risk. Then you have the claims department. Their job is to investigate and pay claims. And then A is the actuarial department, and their responsibility is the financial soundness of the insurer at all times.
Collection is different.
No,
Doesn't have
no.
to
This is the actuaries, the brains behind it all. They determine the premium rates, right?
That's right.
back in the day, we didn't have software systems. We had a rate book. Well, I had a software system, but some companies even then still use rate books. Or like if our computers went down, we had to resort to the rate book. So in the rate book, you would see, okay, male, such and such age, $7 per unit or like 50 cents per unit, right, for term. So then because they're young, it doesn't cost very much. So then you would go and you have to do the calculations. When the actuaries got their hands on these software systems, oh my gosh, forget it. It became so much easier,
The
right?
long cards.
So now you can just put your client's name in, put the client's name, their date of birth, and you say their standard just to start the game, and you push enter, and then it illustrates it for you. There's really no math that you have to do as an agent today. And it's just a guesstimation because remember, they have to go through underwriting. So the underwriter can determine what their rating's going to be. Now, you can remember this as Muka or Mauk or I don't know, Camus. Just remember the 4 departments, okay? Another part of this would be like the fraud unit inside the claims department. That's also required also on the state exam. Like I said, for real world, there's so many more departments, it's not even funny. So who's
What's the
responsible?
U? Sorry, what was the U?
Underwriting.
Underwriting. Got it.
So you said marketing, actualization, underwriting, and claims department, which also includes fraud.
Actuary department.
Actuary. Okay.
Or actuarial. So Nicole, who's responsible to submit the financial records to the insurance commissioner annually?
Is that the actuary?
Yeah.
Okay.
Who determines if there's a dividend to be paid?
Actuary.
Who knows the financial soundness of the insurer at all times?
Actuary.
You
All
gotta
right.
remember.
I'm gonna make sure I get that word.
Yeah, who determines the premium rate? Actuary.
Yeah.
Right? Who determines the client's rating? Their class.
Underwriting.
Yeah. So these are easy if you remember, keep it simple. Okay.
MAUC, that's the process of where the insurance goes.
Those are the departments of insurance. The different they claim only 4 departments inside an insurance company. It's a lie. Okay. Don't believe them.
One more time, don't believe what
How many departments there is there's claiming there's only 4 departments: the marketing department, the underwriting department, the actuarial department, and the claims department. There's way more than that. But they're only testing you on 4.
Oh, okay.
Yeah. But there's way more. I just don't want you to go to Northwestern Mutual and then you have so many more departments and you're like, Jackie lied to me. Remember, real life test life sometimes does not jive. Okay. All right, let's continue. And I don't know how you feel about this, Sean, but we might have to add a couple more days because this is taking me a little bit longer than I thought. Because I want to make sure we cover all these possible questions.
I'll keep my questions down to a minimum. Like I want to make sure Nicole gets everything out of this since her test is tomorrow. And then I have a week, so we can do more.
Yeah.
I appreciate you, Sean.
I got you.
The process where an insurer has an agreement with other insurers to share amount of insurance over its retention limit is
reinsurance.
So now as we go over the questions based upon the boards that we covered, does it make more sense? You seen the answer, Nicole? Yeah.
Mm-hmm.
Good. What 3 major categories do life underwriters use to base life insurance premiums?
Mortality, interest, and expenses.
So again, why are they saying do life underwriters use? Isn't it the actuaries that determine the mix? They determine the premium rate. Remember, the underwriters are looking at the mortality of the client specifically to determine what's going to be their rate. Their their rating. Sorry, their rating. Or are they standard, substandard, preferred, select preferred? Like what is the rating they're going to get? That's what that's the distinction there. That's why the answer is the answer. We know that the actuaries in real life, it's the actuaries that determine the premiums using mortality, interest, and expenses, right? But this is where you have test life in real life, and you also have a situation where you have test makers that don't understand what they're doing, right? Okay, So I want to make sure that's clear. Don't jump to the wrong conclusion over that. If the proposed insured dies before the policy is issued, but while in possession of a conditional receipt, the company is or is not required to do what?
We'll pay the
Pay the
policy
policy
proceeds
only if it would have issued the policy to the proposed insured had he or she been living.
So remember, the conditional receipt will basically provide in what conditions they would pay and in what conditions they would not pay. Okay? Basically, if she was insurable, they'll pay. All right, which of the following is part of the application?
Agent report,
Report.
What is a standard risk classification?
rate person on age, health, habit, and occupation.
Occupation.
And these are always on the test. What type of insurance company is owned by its policyholders that can be described as a?
Mutual insurer.
Sure.
Thank you. The department responsible for evaluation, selection, and distribution of risk is?
Underwriting department.
department.
Which premium has the lowest cost?
Term.
Annual.
Oh, annual.
Whenever you pay annually, your premium annually, the investment result is different, so it's always the lowest cost, okay? It tells you they have higher returns.
It's like the way to remember that. It's just like the more transactions, the more expensive, right? Like within anything.
Yeah, some people look at it that way, like their administration cost, but it's not. It's the investment result that the insurance company is going to get because they have, let's say, $1,000 to invest up front versus 100 every month. Does that make sense?
Got it.
The
Yeah.
investment result is different. All right, how does the agent provide documentation of the free look?
Signed document by
Signed
applicant.
document by applicant.
Thank you. What is the insured rated against on a standard risk classification?
Rate person on age, health, habit, and occupation.
It's very similar to the one that we saw earlier, worded a little bit different, but the answer didn't change, right? The
Right.
answer was the same. So don't get all worked up on, like we said, how they like to play with you. Persistence is important for all the following reasons, except
Each year
Each year the policy is
Each year the
enforced,
policy
more
is
insureds
enforced.
will use the benefits.
all right. So with that being said, I know we have like a delay on the verbiage. Could I get Sean and Nicole to mute? But I'm still gonna watch your lips. But Nicole, bring the camera down a little bit because I can't see your lips moving. There you go. Much better. Thank you. And then that way, we don't have yeah, and then that way you guys can say it and it doesn't affect you guys. And then for you, you can still say it, but hope you guys don't, you don't interrupt them. All right. So again, persistency is important because it costs so much to put the policy on the books. It's like 3 years usually, those acquisition costs. So because of the acquisition cost, the insurance companies want you to keep the policy on the books. It's called persistency. So when you have a high persistency ratio, that means you have more clients that are keeping their policies longer. They'll give you a persistency bonus around 15 to 20 years, depending on the company, where instead of only getting the residual of like 3%, they're giving you like 15 to 20%. Yes.
Who's getting paid when they're paying in
Every time you sell a policy, you get,
or not actually, what's it called?
it's part of the expenses of the insurer. What's your question? I don't want to cut you off again, sorry.
Trying to remember what it was called, mergers or like when they're doing acquisitions, like they have to pay, right?
This is different. When I said acquisition, I meant like you go and you find a client and there's a cost for that client. You're going to do the, right? You have to send them through underwriting. So there's an underwriter that's involved. They sometimes have to go get a medical exam. That's on the insurance company to pay for that. Then you have your commission that comes from the insurance company. So they, there's all of these costs associated, policy taxes that they have to pay. So because of that, they want you to keep the clients on the books. In fact, state exam answer, if your client cancels within 1 year of purchasing the policy, you end up with a chargeback. What's a chargeback? Well, you got to pay back that commission that they gave you because your client did not keep the policy for that full year.
They ended early.
Yeah.
Question with that.
Yeah.
So like, let's say they canceled out at month 10, right? They stopped paying
Yep.
at month 10. Do you
Full
pay the
chargeback.
full chargeback?
Full chargeback. I know. Isn't that crazy? It breaks my heart, but yeah, full chargeback. I couldn't believe it either. I was like, what? No
I have a
way.
cousin, her agent used to like call her all the time, like, are you gonna make the payment? Da, da, da. And I used to be looking like, why is your agent so aggressive?
Why is she harassing you? Now you know
Now
why.
I know.
I'm trying to eat.
She doesn't pay her, she doesn't want to charge back. All right, real quickly, we'll cover this and then you'll see it in the book. Based upon where the company is organized determines whether it's domestic, foreign, or alien. If it's in the state of California and you're standing in the state of California, it's domestic. If you're standing in California, it's outside of California, but within the United States, it's foreign. Right now, they're using Nevada as the example. If they say Texas, New York, still the same thing. But if it's outside of California, like Mexico, Great Britain, England also is used, then it's considered an alien insurer. Now, domicile is the new way they're saying it, but the old way you'll see is organized, where the company is organized. There's also another question which I really like, because I'll actually be able to show it to you, where it talks about alien insurer is, and I can show you how they try to trick you. Okay. But do not collapse whether a company is domestic, foreign, or alien with if they're admitted or non-admitted. Admitted means that they went through all the red tape, all the hoops to be considered to be admitted or authorized to transact in the state of California. They have a certificate of authority for the class of insurance that they're going to sell. But if they did not go through the red tape, they don't have enough money in their reserves to even be qualified to sell in California, then they're considered a non-admitted carrier. Remember, the non-admitted carrier can only sell through a surplus lines broker or a special line surplus lines broker or a citizen on his or her own property. So Sean hears me say that. He looks at his auto policy. He's paying so much money for it. He decides to go and start shopping for insurance, and he finds one that's out of Nevada. He buys it. He has an accident. He submits a claim. They don't pay. So what does he do? Can he call the Department of Insurance of California to get them to pay? No. Why not? Because they're not admitted in California. They have no jurisdiction over that insurer. He would have to go to Nevada and sue that insurer in Nevada. Because clients are taking that risk, right? The Department of Insurance says you as a licensed professional cannot in any way help, aid a non-admitted carrier to do business in the state of California. If you do, it's almost as bad as aiding and abetting a felon.
That's
Okay,
a
not
federal
really, but it is a misdemeanor.
misdemeanor.
Okay? Why? Because the only people that are allowed to work with non-admitted carriers is your surplus lines broker or your special line surplus lines broker. Why? Because they're the ones that are going to collect the premium tax and pay it to the Department of Insurance.
Those are SIEs.
Surplus line brokers, not on the life side, on the property casualty side, but on your test nonetheless.
Got it. Okay.
All right. When you see captive insurer, we saw this already on Saturday. Parent company is your keywords for that one. All right, let's go back to the playbook. All right, so we were here. An insurer organized under the laws of the state of Nevada is foreign. The process whereby the mutual insurer becomes stock is called.
Mutualization.
All right, thank you. Now, again, you might get the other one where the answer is mutualization. Let's go over here to these questions. Oh, looks like we got more over here in chapter 2. All right. So this is all about the insurance companies here. The entity which usually issues participating policies which allow the policy owner a right to receive part of the divisible surplus of the company is known as what?
A mutual insurance. I'm sorry. I don't
Thank
wanna
you.
interrupt anybody.
An insurer owned by a parent company that provides insurance to cover the parent company's loss exposure is what?
A captive insurer. Okay,
Thank
okay.
you. The insurance company blank department is responsible for selection, classification, and distribution or rating of the risk is known as?
Keyword selection.
Good job. Which of these entities usually do not issue policies that grant the policy owner the right to share in the profits of the company?
Stock insurance company.
Remember, non-participating policies is what they issue. In the rating of substandard high exposure life insurance risk, the method where the risk is classified to the severity of the impairment is known as
Tabular.
one of the harder questions on the test. You have to know all the other ones so that you don't get tripped up. Rated up age is, Nicole, how young are you?
42 young.
Well, I'm so sorry, Nicole. They actually, after doing their, underwriting on you, they actually found out that you have wear and tear of, because all the partying you did, all the wear and tear, actually, they found that your body's of a 60-year-old. I'm so sorry. So they're gonna rate you up on age. Sorry to do that to you, Nicole. I
Oh.
probably should have done that on Sean.
So quick question. I don't understand it. So I'm asking, I know like there's certain things that Irma, she'll say like, you don't need to understand it. You just need to know the answer to it. Is
Yeah.
this one of those ones or is this
Well,
something that I could understand?
because they're all right answers for a different question, you should know that what tabular rating is. So again, words do mean what they say here. So rated up age, I just rated you up in your age. Even though you're 42, I said you're 60, right?
Right. And that's what tabular rating is.
No, tabular rating is where they have a list of all the different impairments, all the ailments. So
Uh-huh.
you high blood pressure, you have high cholesterol, you
Okay.
have diagnosed colitis. You're still insurable, but based upon the table,
You're
will
going to get
determine
rated higher.
A, B, C, D, E, right? Every company has their table,
Yeah.
right? Where the risk will remain constant throughout the term of the policy, they're just going to charge you flat additional premium.
Got it.
Okay. And then when you see graded death benefit, it starts, you ask for 500,000, but they're like, Nicole, you know what? We don't know what's going on with you. For the first 2 years, we're going to give you 250. And then after you make it to the 2 years, we're going to give you 500,000. So they're going to
Got it.
grade your death benefit up. So they start
Got it.
lower for 2 years and then they increase it. So by understanding the other ones, you won't pick the other ones for this question,
Mm-hmm.
but which one will you get? I don't know. I don't know
Got
which
it.
one you got to know them all.
Got
Makes
it.
sense? And if I just confuzzled you, it's only one question on your test.
You didn't.
Okay, good.
Okay.
All right. An admitted insurer is insurance companies that are owned by individuals who purchase shares of stock for which those individuals share in the profits in proportion to shares owned and for which the individuals
Only compartments.
vote for a board of directors is known as what type of insurer? So remember, they purchase shares of the company. So that's stock. If it said policyholders, it's mutual. Do you see where it got you?
Owned by policyholders,
Yeah.
owned by stock shareholders, yeah.
The process whereby a mutual insurer becomes stock is called,
Demutualization.
if they change and say stock to mutual,
Uh,
stock to mutual,
so, don't tell me, oh my gosh.
Oh, if it's
John.
stock to mutual is mutualization and then demutualization for reverse.
thank
Okay.
you. Good job. Remember, putting those two letters D in front of it changes it. So stock to mutual is a mutualization. If a mutual doesn't want to be mutual anymore, they have to put the DE in front of it to, right? DE in front of any word takes it away, right? I know, like I said, going back to third grade. Whenever you see the word fiduciary, what you're looking for, the answer is premiums. Sometimes they flip it, fiduciary is in the question, and this is the answer. So again, premiums, money is fiduciary. So an agent acting as an insurance agent, broker, solicitor, life agent, or bail agent acts in which capacity when handling premiums or return of premiums for the insurer? It's the highest trust somebody can give you is that fiduciary capacity. Which of the following functions is best defined as the insurance companies identifying and selling to potential victims? No, I'm just kidding. It says customers.
Customers, marketing, you got me.
We are part of the marketing department, right? We are the producers.
Multi-level market.
All right, members, no. Members of Medical Information Bureau are required to report.
Medical impairments found during an underwriting process, you're like, we're not Grant Cardone.
So remember, Medical Information Bureau is actually a nonprofit organization financed by life and health insurance companies, And what they do is they have a centralized computer system that houses the medical impairments that they found during their underwriting process. That way, in the event that that client tries to go buy from another company, there's a red flag already on them. But remember, that company cannot solely base their decision on that MIB or your agent's report. Okay. An insurance company which is owned by individuals who purchase shares of stock in the company, share in profits in proportion to shares owned, and vote for the board of directors is known as what type of insurer? Again, why so many times are we seeing this? Because I already told you, they want to make sure you know it. A company that issues policies which do not grant the owner policy the rights to receive policy dividends. Look at side by side how it's stated. Very close, but not exact, but still the same answer. Be ready. Which of the following functions is best defined as an insurance company's identifying and selling to potential customers? All right, we saw that already. Okay, let's go to this other side over here. This is the next section, which is the underwriting department here. All right, the Medical Information Bureau gathers information that assists in the underwriting process. This information includes matters such as what?
When an applicant previously applied for insurance,
Why do they need to know that?
so with a system that.
It's a red
okay,
flag.
yeah,
If I went and I bought 100 here, 100 here, 100 here, why am I buying 100 from 3 other companies before I came to your company?
It could be considered
Right?
as fraud. But
I might be trying to hide something. Because if I buy 100 from you, 100 from this company, 100 from this company, I'm going under the radar, right?
stuff like that happens.
Yes.
That's crazy.
This is not from physicians. I just said it, insurance companies belong, right? They're the ones that are putting the information in that centralized computer system. So notice how what I said is actually in a question format. See that? Don't pick this one. Don't pick any of these 3, actually, just the first one. When they applied, impairments found, is all part of it. All right, when using a non-medical application for life insurance, a common practice is what?
If the answers given in the health statement do not meet the company's underwriting standards, a medical examination is required. I would assume they would.
This is the hardest question on non-medical apps, I think, to be honest with you. They must meet the underwriting standards of the insurance company to not require that medical exam. Which of the following substandard risks listed below would be classified as an A or AA rating?
Secretary.
And we're not called secretaries anymore. We're called administrative assistants. Everything else is considered what? High risk, higher risk. Yeah.
What was the law?
But secretary is pretty good. That's easy. The lowest risk is that secretary. All right. Underwriting information can be obtained from each of the following sources except.
The insured policy reserve.
Yeah, no duh, right? They're going to look at medical exams, inspection reports, and the MIB, but they're not going to go into the insurer's policy reserves. That's crazy. That doesn't even make sense. The Medical Information Bureau is a nonprofit organization supported by which of the following?
The life insurance companies.
The new question on this, Sean, you got to be very careful because the truth is it's life and health. But because of PPACA, the Patient Protection Affordable Care Act, which is Obamacare in real world, life insurance companies are still financing it. Life insurance companies are still financing it, but health insurers, guess what? Because the service insurers don't use them anymore, that's what they're using as the distinction here. But remember that disability income and long-term care companies still use it. Okay, so if you get the choice where it says life and health companies, you got to pick it. That's the better answer. Okay, if it splits it, it says life here and health here, you got to go for life. Life is a better answer of the 2. Oh, I don't even know where the question went there. We're going to have to skip that one for now. All right, all the following are considered adverse underwriting decisions except.
Failure of the agent to submit the application to the insured.
Ouch, that's just the agent not doing their job. Everything else, it would be a decision by the underwriting department. Decline, charge higher premiums, or terminate the insurance. But if you forget to submit your application, ay. Make sense? Oh gosh, I'm not sure what happened here. Looks like somebody or me, probably when I was looking through this, I might have deleted something. All right. The person whose life is the object of a life insurance policy is the
Issue. No, policy on. Insured, it's insured,
yes, the insured.
insured.
The insured is the life that's being protected in the policy. Okay, this question I can tell you is nope, but because this is, I'm gonna just delete it because this is good. You'll see it in the, for sure in your playbook, all of it together, but I don't want to confuzzle you guys on that one. Oh, it's not looking me change. Okay. Which risk classification carries the highest premium?
A substandard risk
Remember, preferred is the lowest, right?
term.
Why not endowed? Because an endowment is the highest premium. Because it is not a risk classification. That's why. These three are risk classification. That's just thrown in there to distract you. It's called a distractor. Highest premium is a key word for endowment, but not for this
Risk
distinction.
classification.
Not in this question. All right, all the following are factors in determining premiums charged for group disability income policies except,
Yeah, that's.
remember we talked about this one?
I think so.
Because it has nothing to do with disability income policies. Now, if it flips it and it says group health, then the answer changes to elimination period. Okay, so you gotta be very careful with that one. Yeah, I'm not sure what happened to my questions on that one. Looks like somebody came in here because I didn't do that. This question has to do with adverse selection. So what is adverse selection? It's a tendency of those who have a greater risk of loss to apply for and obtain insurance. The underwriter's job is to catch them so that they don't get the insurance if they're too high risk. All right, when using the non-medical app for life insurance, a common practice is what?
If the answers given in the health statement do not meet the company's underwriting standards, a medical examination is required.
Make sense?
Sort of. When using a non-medical application for life insurance, a common practice is what?
Remember, if they don't meet the company's underwriting standards, they have to do the medical.
Oh, yeah, yeah,
You
yeah.
saw it earlier. You did it.
Yeah.
You did good on that one. You just got tripped up on this one. Interesting. See what tricked you? Did you see what tricked you?
Yeah, I think it's covered the first one, company. Medical
Mm.
information, MIB is
All right, the Medical Information Bureau is a nonprofit organization supported by which of the following?
the insurance company.
I like that. It's more accurate. All right, insurance companies have several departments. Here's the one, handling various responsibilities in the issuance of policies. Which department handles adverse selection?
The underwriting unit.
Remember, the key word is selection, classification, distribution, and rating of risks. Which of the following supports the MIB?
Life insurance company.
I prepped you for this one, right?
Yes.
Remember I said, Sean, if they're both choices separately, you got to go for life. You can't pick health, okay? All right. If the proposed insured dies before the policy is issued and receives a conditional receipt, the company,
Will pay the policy proceeds only if it would have issued the policy to the proposed insured, had he or she been living.
yeah, so if she was or he was insurable, then they would pay. If they weren't insurable, then they don't have to pay. So for example, let's say I sell you a policy, Cheyenne, and I hate to do this to you, but let's say you walk out of here and you have a heart attack. You have no history of heart issues at all. At all. They'll pay. But if they find out that you went to a cardiologist last week and he said you needed quadruple bypass and then you died, then they're like, nah, you wouldn't have been insurable, so we're not going to pay. Or if you go out there and you kill yourself, right?
Yeah, that's absolutely, yeah, it's my choice.
Make sense?
that does.
What is required when an applicant reveals conditions that require more information?
Attending a position statement, so same exact correlation to the previous.
Similar,
Yeah,
similar,
It's like
but
a
not
phone.
exact. They're gonna ask for the doctor's information now.
got it.
And
Okay.
when it's suicide, they basically will only pay back the premiums, right?
When it's suicide, they'll only pay back the premiums. That is true.
Okay.
All right. An attending physician statement is required when the applicant answers reveal condition that may require additional information. And we already said that. That was the explanation. Sorry about that. Which risk classification carries the lowest premium?
Preferred.
These are my easy peasy questions, I think. Right?
Uh,
Lowest risk, lowest premium, if you're preferred. All right. Members of the MIB are required to report what?
Medical impairments found during the process. Okay.
Make sense?
Yes.
To
I don't
author,
think-
this is important for the test. To authorize the release of the attending physician's report, what must the applicant do?
Sign a release of information consent form.
What if it says written consent, written authorization? Should you pick it?
No.
Yeah, means the same thing.
Oh, I thought I saw like.
I'm just saying it differently. So if you're, I'm gonna pick on you, Cheyenne. If you're, and Nicole, if you're expecting to see this word for word, you're in trouble. That's what I told Frank. He's like, it was worded different. I said, Frank, I promised you that. I promised you that. But how were you able to get 80%? Because you learned it, right? You danced in the conversation. He's like, yeah, but it totally threw me off. I know I promised you that. If you're not ready for it, right? Be ready, dance in the conversation, you'll be fine. Which risk classification carries the highest premium?
Substandard.
Make sense?
Risk classification that has the highest premium.
Why is substandard the highest premium?
Because it has.
It's the highest level of like,
Substandard. So here's standard. Substandard means I'm below average, right? Here's standard. I'm
Oh.
substandard. I'm below average, which means I'm a higher risk. I'm a
right.
high risk. I'm gonna pay the highest premium.
I got it, but I think I said it in reverse, but I understood it.
All right. I got you. The request for the attending physician's report must be accompanied by a copy of which of the following?
Signed authorization.
Written authorization, sign authorization, means the same thing. All right. Wow. We got to chapter 2. It looks like we have a little bit more over here. Let's take a peek. What do we have here? Oh, this is always fun. This is, again, we're still in code and ethics. We haven't hit life yet.
Still general insurance.
During the free look period, a person returns a variable annuity invested in mutual funds. What will they receive? Ooh, where's my, so the keyword is mutual funds. The answer would be account value. Did you get that, Nicole? And the keyword in the question is because of the variable annuity, mutual funds. That means the money was directed. If it said here money markets, that changes the answer to premiums. See that? All right, their insurers required to set money aside to pay claims. What are these monies called?
Reserve.
Also known on your state exam as loss reserve. So another way they'll say this is what is used to pay claims? Loss reserve. What if they just say reserves? You got to go for it because it's the same thing. Make sense?
We're never going to think both on the same question.
All of the following are part of the life insurance application except
Attending a physician statement. Does that mean that you'd be potentially adverse?
remember, there's 3 parts of the application. General information, medical questionnaire called the non-medical app, and the agent's report. Those are the 3. This, it's interchangeable. They'll put this one here or EFT. Sean, what's EFT? What's an EFT? Do you know?
I don't know.
You probably do know, you're just not connecting it right now. EFT stands for electronic funds transfer.
Got it.
That form that your client has to sign to give permission, guess what? It's handled during the application appointment, but it's not part of the application. It's not a form on the application. Does that make sense? Okay, good. List the following policies from lowest premium to highest premium. Irma taught you this one. Nicole, which one is it?
It's MOS, it's the modified ordinary single premium.
Good job. So you remember MAS the same thing? Right? MAS? When you have little, then you have more. MAS? What if it says the highest to lowest?
It's in reverse, then it's single premium, ordinary, and modified.
Yeah, SOM. So your energy is up here and then it goes down. Your energy is somber, right? You become somber.
Song there, though.
What? It's not a choice, yeah. Which of the following is required to obtain from the insured if the insurer is requesting that the insured be tested for HIV?
Yeah, obtain a
When it comes to HIV, AIDS, and all that, we disclose to the client that an HIV test will be taken, and then we ask them, where do you want your results to be sent? The client decides. Make sense? Any questions? No questions? All right. So that completes chapter 2. When we get back from a little break, we're going to jump into chapter 3, which is all the policy information. Okay. There's 10 questions on your test on policies. Which one will you get? I don't know, but there's 10 of them. Okay. So we'll take a quick little, it's gonna be quick, just 10 minutes. Okay. Meet back here at 8:15, grab some more coffee if you need to, grab what you need, and then we'll get back to work at 8:15. Enjoy your break.
Perfect. Thanks.
Thank you. Well, I'm so happy I'm like on target for this class.
Really?
Yeah, it's 8:16. I'm only 1 minute late.
I think that whole question of like, oh, it's a smart test, not a smart test, set us a whole hour
Really
back.
threw
It
us
was
off.
30 minutes
Yeah.
that we were like, she was saying that like, oh, this might not be what we're
Was it
doing.
30 minutes?
It
No.
felt way longer.
Hey, Sean, can you see my boards or my
Yes.
slideshow? Oh,
I'm looking at your Excel doc still, chapter 3.
yeah, it's kind of weird though. It's not letting me view you the same. All right, so long as you all can see it. Let me move you guys out of the way here. So my friend Sean doesn't get all. All right, chapter 3 is all about insurance policies. So we're gonna use the board real quick to preview everything. When we talk about life insurance policies, we said there's 10 questions, but I don't know which 10. So we're gonna simplify it. There's two types of, well, actually there's 4 types of life insurance policies. We don't sell industrial life and we don't sell credit life. And then there's permanent insurance and then permanent insurance. We do sell these two. Term is like renting, we say. When we sell it, our companies will teach us how to sell it. And they like us to use the analogy of renting and owning a house. So term is like renting an apartment or a house. When you rent the house, you have a roof over your head while you're there. But after the term is over, that year, you either have to sign up for another year or we usually have to find another home for another year or however long it is. But what tends to happen is the cost of the rent will go up, right? Every year, every few years.
$200-300.
Depends on what kind of lease agreement you have, but all you have is a roof over your head during that time period. Where owning is like you're paying your mortgage, you have a roof over your head, and you're building equity inside that home, right? Everybody understand that distinction?
Yep.
You
Do you-
mentioned before.
Can you see my term perm board?
Yeah.
Okay, good. All right, so the key distinctions on on term is that it's insurance protection only for a specified period of time and there's no cash value. Compared to perm, it's insurance protection plus a forced savings account, which is our cash value account, also known as the equity in the policy. Okay, let's hone in on these term policies. There's 4 types of term policies you have to know. The first one's called decreasing term. Words mean what they say. Decreasing term means that the death benefit decreases over time. Now, usually this policy is good for mortgage protection. If you've ever purchased a home, when you buy a home, they'll offer you a loan called a 30-year. Sorry, I'm multitasking, trying to see trying to see both of you actually. Can't see you guys, it's kind of bothering me. Okay, there you are. Where was I at? Okay, so are you okay doing it this way, Cheyenne? You
Mhm.
good? Okay. All right, so, and you guys see the whole board now, right?
Yep.
I have you separated, so I'm trying to work it out here. All right, so in a mortgage redemption, when you buy a 30-year fixed loan, when they give you a 30 fixed loan, the amortization table, if you ever look at it, it's created where, let me see if I can use the board behind me. Can you guys see this board behind me? With all
No.
that stuff?
It's blurry.
It's blurry,
I can't
yeah.
really see it.
Okay, let me see if I can use, there is, but see how the Zoom is like, we're not, it's being wonky right now. I'd have to like, let me see if it lets me do it. Okay, here's the whiteboard. We're gonna change to the whiteboard real quickly. Or not. Okay, we're gonna do a new whiteboard. Okay. I don't need comments. Okay. So when you purchase a home, you have what's called an amortization table. In the amortization table, this depicts what's going on inside the principal balance of, oopsies, that didn't work. I didn't like that either. Let me erase it. Let's get this eraser. Okay, let's try that again. Okay, so this amortization table depicts what's going on with the principal balance of the loan. Pretend that it's actually a better line. If after 20 years of paying your mortgage, you die, this line depicts how much you owe in that loan. Your decreasing term policy will emulate this line. Let me stop doing this line here. Will emulate the line. So again, if you die after 5 years, this line tells you how much you owe in the loan. The decreasing term policy will be exactly the same at the 5-year, the 10-year, 15, whatever, all the way down to 0. So at the end of a decreasing term policy, you owe nothing in your loan and you have nothing left in your decreasing term policy. Make sense? So state exam question will say, what's the best policy for mortgage redemption? Decreasing term. What's the best policy for mortgage protection? Decreasing term. Now, if I sell you, now this is real life, Sean. If I sell you an interest-only loan, would a decreasing term policy be the best policy?
No.
No, because it's going to be going down, and it's like, wait, at the end of my interest-only loan, I still owe the full $500,000. I'm being of disservice to my client. For that, I want to sell them a level term policy because the death benefit will remain level over time. Does that make
And
sense?
the interest only is when people have
You
like
only-
reverse mortgages.
No.
Okay.
Reverse mortgage is eating up at the equity of the loan, but we don't want to collapse that. Interest only is when we have a loan where only the interest is being paid to the lender.
Mhm.
I'm not paying any money towards the principal balance of the loan. So if I borrow 500, I still owe 500,000 at the end. Make sense? A reverse mortgage allows you to take money out of the equity of the home, and I'm not 100% familiar on how those contracts work, to be honest with you. All right, so looking at term insurance, though, a decreasing term policy, remember, death benefit decreases over time. Not to be confused with increasing term. Words mean what they say. Under increasing term, the death benefits is increasing over time. And in real world, we don't sell these as standalone policies. They're blended with our other policies, and it serves as inflation protection. So as the death benefit increases over time, right, so does that cost for additional insurance increase over time. You'll see that in the COLA rider, okay, in the cost of living adjustment rider, inflation protection rider, we use increasing term. Now, ART, which stands for annual renewable term, has a level death benefit, but has an increase in premium, and that increase in premium with an annual renewable term increases every year tied to your age, tied to your mortality. In the beginning, it's really low. I bought $1 million for $32 a month when I was 34 years old. Okay, very inexpensive. But as I started to age, that policy premium went up. So I started converting some of it. The whole situation with the annual renewable term policy that I bought was because I didn't want a 20-year term. I just wanted a small policy to help me until I converted it all over. Okay. Make sense? Not for everybody. For sure, not for everybody. And it's a short-term solution. In fact, state exam question, what's the most common group plan? Annual renewable term, because it's the most inexpensive way. It's only for that year. If my employees leave, whew, I don't have to pay it anymore, right? Now, do not confuse annual renewable term with the level term. It does also have a level death benefit, but the it has a level death benefit, but the premium doesn't increase every year. It increases based upon what type of policy I sold them. So if I sold you a 5-year level term policy every 5 years, if it has a renewability provision, if, keyword is if, it has a renewability provision, it will renew for another 5 years, but at an increased premium based upon your attained age. Make sense? If I sell you 10 years, it's for 10 years, 15 years, but only up to a certain age. So see policy. Some renewability provisions say after age 60, it renews every year tied to your mortality. So you got to be very careful on the wording of the renewability provision. Typically, if I sell you a 20-year term, on the 21st year, if it has a renewability provision, it skyrockets so high that you're like, yeah, no, I don't want it anymore, right? I'm gonna let it go. I don't need to pay. If I want more, usually I'll buy another policy. It'd be less expensive than trying to renew that policy, to be honest with you, unless I'm uninsurable. If I'm uninsurable and I'm going to die in the next 6 months, I'd probably pay to renew it. But in real world, most people, they say, I don't know if you know the statistic, but scratch, delete. Only 2% of policies will pay out. Term policies, that is. Only 2% of term policies will ever pay out. Why? Well, sometimes they term out. Remember I said 20 years after the 21st year, it's really expensive. So they'll term out, they'll just let it expire. The second reason is that they'll convert it or people just cancel it. They're like, you know what? I haven't died yet. I don't need it. Things are tough. I need to find some money. I see some money over here. Let me let that go. Right? Make sense? All right. So again, key point for level in a level term is level death benefit with a level premium, not to be confused with renewable term, which has a level death benefit with an increase in premium. Be careful for the renewability provisions. Remember, renewability means you can renew, but an increased premium without proof of insurability. POI is what I say proof of insurability is, without evidence of insurability. Do not confuse renewability with convertibility. What the heck does convertible mean, or conversion privilege or convertible term mean? Convertible means that you can convert it from term to perm and you do not have to prove insurability. Remember I said that $1 million annual renewable term policy I paid for 1 million, I paid for a $1 million policy. I started converting that because there was a conversion privilege in there. So I don't have to prove my insurability, which is really cool.
How do you determine
Say again?
how are you able to determine the convertibility based off the opportunity? Like, was it a
The client, I'm sorry, the agent that's selling the policy should know if it has a convertibility privilege or not.
They look at the numbers, they see the opportunity I see.
Yeah. Do you guys know what an illustration is?
Like,
Sean, do you know what?
I mean, like a table or like what? Probably not.
Illustration.
Like when I think of an illustration, I think of like what you're drawing up there on the whiteboard.
Oh, got it.
Is
Okay.
it more like the policy being written up? Like that's the illustration, the contract?
Yeah, it's actually it is the what do you call it? It's the, let me see if I can grab it real quick. It is the presentation that you're going to show your client. Ooh, Sean went away. You still there, Sean?
Yeah, I'll be
Did I
right
lose?
back. No,
Okay.
you're good. I had to adjust my camera.
I was like, where'd he go? Oh my goodness, he ran away. In the illustration, I want to show you because there's about 4 to 5 questions on illustrations. We're jumping into chapter 4 right now, but I want to show you the illustration so you can see like exactly what I'm talking about. Except for my search bars like being very wonky. Let me see if I can find it in my drive. Come on. I'm glad I didn't lose you because it's like spinning over here. It's not going into my drive. Now, I am not by any means promoting any company at all. The only purpose of me showing you these illustrations is because with this specific company is because it's easier to have an illustration than to show it to you than to have you visualize it. So again, I'm not promoting any company by any means, but this is a 20-year guaranteed, look at convertible term. The name of the policy tells you what it is. It's really important to remember that. So when you're taking your test and the question says, which of the following would have the lowest premium? Well, if it's a 20-year level term policy compared to a 10-year level term policy, you'll be able to figure it out a lot easier. The name of the policy tells you what it is. So remember I was telling you, oh, sorry, rewind. Notice how it has a lot of information. The name of the policy, it's supposed to have value client there. One of my students prepared this for me. It tells you the company name, the address. It's very detailed, okay? And it tells you this is for a male 44-year-old. I think that's how old he was. And the birth date here, 44-year-old would pay for $500,000, 20-year term for this company. Notice that it's a preferred rating. That means healthy, $77 a month, Check-O-Matic. Annually would be $876. Okay. Now, as I scroll down, it's telling me if I pay annually what it is, if I pay monthly what it is. Remember I told you monthly is actually more than quarterly, but real life it's not. But that's TMI. All right, look at all the definitions. Remember we talked about adhesion? Because of adhesion, guess what? They have a lot of disclosures here already. But I want you to look at the policy illustration. Notice how we have a certain spacing right here. Sean, why is that spacing so important? And why would it even be on your state exam?
To break out the insurance company, or just so you know where it's coming from.
That spacing is because people would actually give incomplete illustrations and it would run off the page.
Got it.
So now they're like, no, you have to have spacing in there. You can't just like put as much information on there and not care how it looks
Sure.
like. So that's one reason. All right, this is that 20-year term we said. So look at how the premium is level for 20 years. And remember I said it becomes astronomically so high in the 21st year? See that right there?
Yep.
It goes from 930 to 18,000 for that year. That's how it works. Because remember, let's go back to the Facebook page. Your mortality right here in the beginning, you have a very low chance of dying. But as you get older, the chances of you dying is higher and higher. So for those 20 years, they leveled the premium. State exam question. Oops, where did it go? Ay. Here it is. There. So in the beginning, they leveled it for 20 years, right? It's all level. And then it goes to annual renewable. That's how this is being illustrated. So if you look at this right here, right? This line is like every year annual renewable. When they average out the premium state exam question, you're going to pay more in earlier years to offset the cost in later years. But once you hit that 60 years old mark, it's just high. Goes up and up and up. When you buy, let's go over here. When you buy permanent insurance, you're going to pay even more because they're taking into consideration your mortality up to age 100. So this right here, this level premium for a 25 to 45-year-old, it's not taking in consideration your mortality for 75 years, it's only for 20 years. So for an additional 50 years, the actuaries have to determine like how much premium should we charge them. So what they decided to do was we're going to charge them way more That way, what we'll do is we'll put some of that money into a cash value account. That's the client's money. And it'll offset the need for insurance later, right? And at the end, it's their money and they can have their money back. But we'll help them in the front end. This is called insurers assume risk in the beginning. But once you're paying all that money into the cash value of the policy, you're building equity, just like you would your mortgage, right? You're paying off your mortgage, you're building equity. In this case, you're building equity into the permanent policy. You have a guaranteed level premium, never to go up, never to go down. You have a guaranteed cash value growth. You're guaranteed to be covered to age 100 when the policy will mature, or they say endows. And it's a guaranteed death benefit paid to your beneficiaries tax-free. Who likes that, right? You like that?
Is that good?
I think so. Nicole agrees with me. Right? Depends on how much you want to buy and leave to your family. Maybe you don't want to leave it in your family. If you need a beneficiary, I sign up. I can be your beneficiary.
Me too.
Are there some people that don't like that strategy of just doing monthly payments based on their lifespan? Like, let's say there's someone that's like uber
Yes.
wealthy, and they just want
Check that out.
a ton of money.
Oh my gosh, you're reading my mind right here.
Also,
See, this is a continuous pay whole life. Under a continuous pay whole life, you're paying premiums into the rest of your life up to age 100. But like you said, I don't want to just pay 100 a month. What if I pay more? Can I pay more? Yeah, that's called a limited pay whole life. If you pay for 20 years, right? So I'm going to pay premiums for 20 years. What happens when I shorten my payment from, let's say, 75 years down to just 20 years?
flickering down.
My premiums are higher, right? But I don't have to pay as much overall because I've front loaded a lot of the premiums. Does that make sense? So the growth is different, right? The investment result would be different if I front load all those premiums in 20 payments.
It's no longer exponential.
But just because I paid them off in 20 payments doesn't mean the policy's endowed. It still has that time horizon for growth to age 100. Make sense?
Time frame.
So you're going to see the conversations on the questions that will say, so-and-so has $100,000 policy. He's age 65 and it's paid up as of today. When would the cash value equal the death benefit? The answer is at age 100. Why? Because that's when it was set to endow. Now, in real world today, we're using a mortality table that says we can live to 120, but the state exam hasn't made that switch yet. So the answer is still to age 100. Okay. Now, people in the affluent community, they're like, 20 pay whole life, 20 payments. I don't know if I want to do that. What if I do a single premium whole life?
Is that a
Single premium, one premium in your, for all the premiums, just one. And insurance companies were doing it. They're like, sure, yeah, we'll take it. So they would pay, like, let's pretend $15,000 for $100,000 protection. And it would just ride.
I was thinking, like,
I'm just giving you an example.
I see.
Okay. For, like, let's say a grandchild of theirs. Right. And by only paying 15,000 or 20,000, they're paying 20 cents for every dollar.
If you don't have a grandchild yet, if you don't have like actual kinship yet, can you still do those things? You end up.
You'd have to do it on your own life, but you're still young, right? How young are you?
I'm not
25?
7. It's
still
downhill
young.
here. So, like,
It's not downhill from here.
I mean, in terms
Sean, how young are you?
34.
Yeah, it's still not downhill for you, right? You're still going uphill.
I hope so.
I want to give Cheyenne some hope here. He's like, it's downhill from here. No, absolutely not. You're still young.
financially, I don't know. I don't know because like we're just printing more money in terms of the.
Oh, don't think about that. That's just to distract you. That's the noise. That's the noise. You got to get it in front of people. But here's the thing. Single premium whole life was very popular up to the 1980s. And it still is for some, the affluent community, because they're not buying life insurance for the cash value. They're buying life insurance for the death benefit.
Yeah.
So when you go to the class, when we have more time to talk about this, we go into estate planning, we go into like the different estate planning policies and how that works. We don't have a lot of time, so we're cutting out a lot. But is a single premium whole life state exam information, is it illegal to sell one? No, absolutely not. When you first buy a regular whole life, a continuous pay whole life or 20 pay or paid up at 65 whole life, the tax advantages is first in, first out. Whatever I put into my cash value, right, my cost basis, I can take out no problem. Okay. The interest stays in there and it can grow. I can take loans from that. In fact, we teach our clients to surrender to the cost basis and then take loans if they're looking at using the cash value. Okay. If they're not using the policy for cash value, but they're using the death benefit for the death benefit specifically, they don't care if they fail the 7-pay test. What the heck is a 7-pay
It's
test?
just gonna happen.
Back in 1988, Congress found out that people were using life insurance as a tax shelter. And they said, shame on you. How dare you do that? We need your money. So they said, all right, here's what we're going to do. We are going to allow you to buy insurance, but if you fail the 7-pay test, that cash value that's growing in your policy will be treated like an IRA. If you try to access that cash value before 59 and a half, we're going to give you a 10% penalty. And now you're taxed as life, last in, first out, known as LIFO. Does that make sense?
And they have to pay
So
that-
they force you to take the interest out first, tax you on it, give you that 10% penalty if you access before 59 and a half, because you paid your premiums too fast because they believe you are using it as a tax shelter. And shame on you for doing that. But if you are only using it for the sole purpose of the death benefit, you don't care about that rule. You're still going to do it. In fact, I always share a story about one of the guys in my office when I was selling insurance many years ago. I knew of him because I was teaching for so long. I was actually teaching his staff. His staff would come through here. And when when I went to go work there, I was being very nosy. And I looked at the leaderboard and I'm like, I want to know how much he was making. All he sold was to the affluent community. That was his niche market. His dad was an agent too, so he took over dad's book of business. So
That's not even fair. It's like,
he was in the affluent community, right? He got dad's book. Moral to the story, I was like I said, being nosy, and I looked at his line item on the leaderboard. The first month that I was there, he made $1.2 million in commissions.
how
And
much?
that was only half of the commission
$500,000?
because you get half up front and half at the end. He was selling single premium whole life,
Just that product?
but and your commission's like only like 30%. Isn't that crazy? Single premium whole life. I know. His buddy was an attorney, was an attorney. He would help him with these trusts called an ILIT,
I've heard of those.
irrevocable life insurance trust. And he asked him one day, how much do you make on these policies? And he told him. So he left being an attorney to go sell life insurance to the affluent community. And I had to take a sneak peek at his payout for that month. And it was $548,000. I'll never forget these numbers. And I was thinking, wow, so next month they're going to have nothing, right?
That's fine.
Guess what, Nicole? Nope. These guys still had over 100,000 in their next month as their payouts, their commissions, because they were working in the affluent community. I was a bit jealous, to be honest with you. I asked one of his staffers, I said, look, I helped you pass the test. You think you can let me just hang out in your office for a day? She said, no. He's very, very intentional about who he lets in his space. I'm like, but I helped you guys pass your test. She's like, he doesn't care. He's very careful who he lets in his office. I'm like, at least get me a job then. She's like, we're not hiring. I'm like, well, never mind then. I'll go work over here by myself. I thought he would mentor me and everything. Nope. Very, very clear on who he lets in his space. Anyway, TMI. But if you're working in the affluent community, you're going to teach them about using life insurance as a solution to pay those estate taxes, right? So some of those people in the affluent community, they don't care about making the policy. But you got to know MEC, once you MEC a policy, once a MEC, always a MEC. What was a law that was passed that created the MEC? TAMRA. TAMRA was born in 1988, the Technical and Miscellaneous Revenue Act of 1988. If you fail the 7-pay test, your life insurance policy changes to a MEC. Okay? Any questions about this so far? All right, good. Let's go back to the playbook. Now this should all make more sense to you all. You ready? All the following are reasons to buy life insurance except one of the following, which is correct. But Jackie, you said the cash value can grow, blah, blah, blah. Yeah, but you're never supposed to sell it as a life insurance policy. I'm sorry, as a retirement plan, excuse me. As a you're selling life insurance, you better sell it as life insurance. You cannot pretend that it's a retirement income policy. Okay. Make sense?
Protection, right? That's the verbiage, protection.
Yeah, it's be very careful on what you say around people that might be working for the IRS. You don't want you don't want them to hear you say retirement income.
Street.
Even though we can, right? We can show the illustration that shows that money, it's not for retirement, it's for any reason.
Crazy.
So what do we use instead? Annuities are for retirement. Okay. Which of the following could be used to pay off the mortgage on a home, providing the death benefit that equals the amount of outstanding debt on the home, no more, no less?
Increasing term insurance.
Now, again, the visual of earlier should be showing up here. What does the phrase life insurance creates an immediate estate mean?
The total death benefit will be paid to a beneficiary on the death of the insured.
Word for word. I mean, can't even play with that one. The usual amount of death benefit in an industrial life insurance policy is, we don't even sell these, but we have to know about them. Yes. Now, the usual amount is 1,000, but this is the next best answer. And the aggregate is 10,000. But now the best answer is less than 10,000. All right, what type of policy has the principal insured covered with whole life and term on the spouse and child? All right, let me really quickly, there's 4 to 5 questions on your test on the family policy. Why so many? Because most of the students are not paying attention. So they want to make sure that they get you somewhere. So they're going to get you on this family policy. Now, family income is no longer the right answer on the test. It was a blended policy with whole life and decreasing term on the breadwinner. And family maintenance used to be on the test. It no longer is, but it used to be the highest premium because it had a blended level term policy with whole life. You're going to see them still, but not as right answers on your test, okay? What are they going to try to trick you with? The family policy. So we said the family policy is a whole life on the breadwinner and term on the spouse and children. Now, when we did this board, back then, Brad and Angelina Jolie were in fact still married. Why do I bring this up? Here's why. I believe this would have been the perfect policy for them. Why? Because they had 3 adopted children and 3 of their own. Now, I'm not trying to, cause any problems, but where did they choose to adopt their children from, Nicole?
They were like overseas kids, right? Not like, I'm maybe saying that wrong, but.
Well, we used to say third world countries. We're not allowed to say that anymore. We're supposed to say developing countries.
Oh.
There we go.
Okay. So I believe they were trying to create the United Nations in their home.
Me too.
I had one from Cambodia, from Vietnam, from
NATO Council.
Doesn't matter. Why does it matter? Like, why am I even bringing that up? Here's why. When you do adopt from developing countries, sometimes the children, their health history, you don't know what their health history is, right? Well, with this policy, it wouldn't matter. They could add additional children without proof of insurability and without an additional premium. That's huge. And on the state exam. Not only that, they can take those term riders and convert those term riders to whole life policies without proof of insurability, as long as they did it before they turned 18.
Before they turn 18.
Yeah. Because children age out at 18. Now, see policy if the company decided to make it longer. But all this right here that I just said took me what, five minutes, maybe 3 minutes to say? 4 to 5 questions on your test. All of fine is true except can only convert with proof of insurability. All of fine is true except must pay an additional premium. All of fine is true except you have to know it all. Which is true of a family policy? What is not true? So they try to play with you on that one. Guess what? They're all in the playbook. If you read them all, you're going to be ready for those family policy questions for sure. And this is one of them, word for word. Remember I told you family income's there, family maintenance is there, but they're not right answers anymore. They shouldn't even be on your test as right answers. When you see it in your playbook, I think we took it out of the playbook actually. But if you do see it, just don't worry about it.
Really quick. So when you have a whole life policy, I'm just trying to like understand this on the second level, but like you have a whole life policy, then you have kids. Do you have to make changes to that policy if you didn't have kids when you originally got the whole
If
life?
this, you talk about this family policy?
Yeah, so like family policy.
So if I bought a family policy, which the company I was with, we did have a family policy, but it wasn't whole life. By the way, it was term riders or term on everybody.
Okay.
Once you buy the family policy, when you have more children, doesn't matter if they're adopted, blood, or stepchildren, they can all be added. Yes, you have to
Got it.
notify them. You have to add
Okay.
them to the policy. On a family policy. Now, if I buy a whole life over here in my life, it's just for me. It's not
Yeah,
automatically family policy, right? It's
that
just
makes sense.
this is a type of policy. So we have all the term policies we talked about, dial, decreasing, increasing annual and level. And then we have the whole life policy. And inside that, we talked about the 20 pay whole life, the paid up at 65 whole life, the single premium whole life. And we talked about TAMRA. And now we're talking about the family policy, right? But there's about 4 to 5 questions. Like I said, they love to test you on this one because most people aren't thinking it's going to be on the test, but it is. They'll
Cool.
also test you on the juvenile policy, but who's a juvenile policy for? For the child, specifically the child, right? Make sense? So if this is talking about the principal insured, which is the breadwinner, right? Has whole life and term on the spouse and children, that is defining your family policy. Make sense? Now we're gonna go on overtime. Are you guys like headset on stopping at 9?
How
Like,
much
do you have a
overtime?
bedtime that you have to? I'm trying to help you out.
I know. I'm just asking. I just need to call my mother-in-law back. She just called. She's 84. She lives by herself. So
Oh, she has the kids with her?
no, there's no kids over there. She's
Oh,
84.
gotcha,
She
gotcha.
lives by herself. So
Oh,
and
you're
she
gonna
just
just
called
check on.
2 times in a row, but I didn't answer. I was like, I'll call her back at 9. But if we're gonna go over, then I want to
Yeah,
call her back.
yeah, you should probably just take a quick minute to call her back if you want to stay longer.
Yeah, I'm gonna do that. You can keep
Okay.
going. I'm gonna listen, but I'm gonna just mute everything.
Yeah, that's good. How about
Okay.
you, Sean? Are you headset on jumping off at 9?
I have some time left. I'm good.
Okay. What are you thinking? Like 9:30? Good.
Yeah, that's fine. I'll probably have to jump off about 9:30 just to get my oldest son down, but we should be good. My wife might be good out there.
Okay, cool. Alrighty. So, again, you got to know all these distinctions here. So what is a characteristic of term life insurance?
Specified period of time.
So going back to the board, I just want to make sure I point it out because we covered this, right? We just covered it. And Sean, you like this going back and forth like this? You're good? You like where we?
Yeah. No, this is good.
Okay, cool. So again, we said term is like renting, insurance protection only, specified period of time, and no cash value. So if we look at here, there's our keyword, right? Specified period of time. The keywords remain constant. The words around it can change. We said no cash value. So that, of course, is not right. All this is for whole life. Make sense? What type of policy covers the principal insured with whole life and term on the spouse and children? We said that again. The answer is
Policy.
thank you, family policy. Which is true regarding whole life?
Insured to pay the premium for life and then down at age 100.
Remember, on a continuous pay whole life or just a whole life, that's level premium till age 100. A life insurance policy provides annually increasing premiums for a certain period and level premiums thereafter. It's known as what?
Life policy.
Yeah, so this one is the name of the policy tells you what it is, right? So strategically, it starts low, graded premium, and the premium will go up over time. Not common. You're not going to see that in real life, to be honest with you. Look at the other policies that they're going to try to trick you with, though. And we said these are never right answers. So again, if something grades up like this, it starts low and then it goes up, that's your graded graded premium. All right, which of the following pertains to ordinary life insurance? Whenever you see all of the above, it's imperative that you read all of the above because those become right answers for other questions. So altogether,
All of the above.
it is sold and underwritten on an individual basis. It is any amount of insurance, usually 10,000 or more, and premiums are paid annually, semi-annually, quarterly, or monthly. Make sense? Yes? All right. How about well, we'll just keep on going. I was gonna say skip the ones we already saw, but I don't want to miss any good ones here. Life insurance may be the most practical means of meeting obligations arising from an individual's premature death because of what factor?
Increase in the immediate estate.
Yeah, keyword, right? Keyword there. Which of the following best describes a universal life insurance policy?
Insurance protection with a cash value account earning a guaranteed minimum interest rate and a current rate of interest with flexible premiums.
All right, so going back to our board really quickly, if we go to our universal life policy board over here, I know it looks a little wonky, but universal life, keyword, we said flexible premiums, current interest. We also said another state exam questions, you have to know the adjustments made. So first they credit the premiums, then they subtract or debit administration and expenses, also the mortality cost, and then they'll credit the current interest. Okay. They're not going to charge surrender charges and they're not going to subtract your agent's commission from there. Okay. Make sense? In fact, the commission comes from the expenses. The client does not pay the commissions straight out like that. Make sense? Yeah? Okay, good. Now, when it comes to an index universal life, everything's similar. The only difference is they don't give interest rates. They give the rate based upon how the index is performing. But if the index is performing in a negative, they have a minimum floor guarantee, depends on which policy you buy. Could be 0% or 1%, which means that cash value will not dip down to the negatives. And then unfortunately, or fortunately, there's a max ceiling, which is anywhere from 12 to 15%. So if it's performing at 35%, you don't get that 35%. You only get the 15 or 12%, whatever your company's offering you. So there's a cap, right? A maximum, a ceiling, all words mean the same thing, or a minimum floor guarantee. Not to be confused with the variable product. In a variable universal life, in the variable products, whenever you see the word variable on your state exam, I don't care if it says variable life, variable universal life, or variable annuities, this concept is all the same. You must have 2 licenses to sell this product, whether it be a securities license, that is a 7 and 66 or a 6 and 63. You are regulated by the SEC, but you are licensed by FINRA, state exam answer. FINRA stands for your Financial Insurance Regulatory Authority, I believe. And then your life agent license, which you're going for right now, which is your California Department of Insurance. In the variable products, the clients gets to choose the investment portfolio that they want to invest in. The policyholder carries the risk. They can go aggressive, moderate, or safe. It's up to the policyholder. Because there is no guarantees, the insurance company is going to protect themselves and they will not put it in the general account. They have to put it in a separate account based upon the investment portfolio the client chose. One of the state exam questions will say, which of the following is the best hedge against inflation? The answer is variable, whatever it says. Variable is always that key word for the best hedge against inflation. Sometimes they'll say, why is it the best hedge against inflation? And the answer is because it has a potential for the most growth, especially if you go into the aggressive portfolios, right? But remember, no guarantees. So, with that being said, universal life, the key word is flexible premiums and current interest. Be careful because there's one that says which of the following has flexible premiums where the client can invest in the investment portfolio they want to invest in, right? It kind of goes over explaining a variable universal life. Some people miss where it says flexible premiums and they pick variable life because there's two choices. Variable life has fixed premiums. Universal life has flexible premiums. So it ends up being the variable universal life answer is the one that you want. Okay, we'll see that shortly. All right, of the following listed answers, select the answer that shows which whole life policy would have the lowest initial premium to the highest.
Modified life, ordinary, where you pay life and 7 pay life.
And it's very similar to Moss, right? Modified M, ordinary O, 20 pay and 7 pay. Those are going to be like not, well, it's not single pay, but it's going down. Make sense? It's a harder version of Moss. Moss is the most common one right now, though. All right. Of the following listed answers, list the answer that shows which term policy would have the highest premium to the lowest.
10-year level term, 10-year increasing term, 10-year decreasing term, and annual term.
Make sense? And if you didn't know, now you just learned something new. All the following are true about accidental death and dismemberment coverage, except
Benefits are paid for losses resulting from accident or illness. Because that's pure.
so all the answers are true except benefits are paid for losses resulting from accident or illness. No, illness is never covered under an accidental death benefit policy. It has to be from the direct result of an accident and you have to die within 90 days. Which of the following is not true about family maintenance life insurance policies? We're going to skip it because we said this is no longer on the test. So we're not going to cover that one. Let's delete that real quick so I don't get confused next time I teach this class. Which of the following statements describes what happens when money is taken out of a modified endowment contract?
This could be considered an early withdrawal and be subject to the 10% penalty. This is regards to the 59.5 rule, right?
The MEC. Once a MEC, always a MEC.
That's the law they did in 88.
Remember, when I sell a single premium whole life, the reason why I told you about the agents that sell single premium whole life is because one of the questions will actually say all the following is true of MECs except, and the answer is selling a single premium whole life or selling a MEC is illegal, and it's not illegal. It happens all the time to the affluent community. All right, which flexible policy can offer a guarantee of mortality and expenses but not interest?
Universal life.
Remember, they give you current interest. They never guarantee the interest there. Joe is 30 years old and purchases a life insurance policy. Which would be his highest annual paid premium?
20 pay whole life.
Remember, when you condense the premiums down to just 20 years, right? Versus 30 years versus 25 years, it's going to be the highest premium. Term is always the lowest premium. When converting term policy to a whole life policy at the insured's attained age, the cash value of the policy at age 65 would best be described as which of the following?
Values will be lower than if ordinary life had been purchased at initial age.
Of course, right? Because he waited to put money into that cash value. Make sense? Which of the following could be used to pay off the mortgage on a home, providing the death benefit that equals the amount of outstanding debt on the home, no more and no less?
Decreasing term insurance.
The usual amount of death benefit in an industrial life insurance policy is which?
Less than 2,000. It used to be 1,000.
Yeah. What does the phrase life insurance creates an immediate state mean?
Total death benefit will be paid to a beneficiary on the death of the insured.
Thank you. Renewable term insurance can be best described as which of the following?
A level death benefit with an increase in premium.
This is question number 2 on page 11, like word for word and on the test word for word, right? Level death benefit with the increase in premium. Every time you renew it, that premium's going up. An individual with low income and high insurance needs should buy?
Term insurance.
Why?
it's the most affordable type of insurance.
For sure. Always on the test. I don't know why they've never taken this one out. I kind of think it's cool, but at the same time, it's like, why haven't they changed it yet? Maybe it's coming. Nicole, let me know. An insured bought 150,000 non-participating policy, whole life policy many years ago. He is now 100 years old today. He has never borrowed from the cash value and has faithfully made all payments when due. The policy cash value is, remember, the cash value equals the death benefit at age 100 when the policy endows or matures.
If he touches it though, is it just 100K?
No, it depends on how much you took out.
Oh, they base
Yeah.
on percentage.
Look at this one is almost, well, you got to know the distinction right here. The insured age 65, I said this earlier, owns a $100,000 non-participating policy, whole life policy. The policy is paid up as of today. He bought a paid up at 65 whole life. When would the cash value reach 100,000?
Age 100.
Remember, the time horizon for growth doesn't mature till 100. All the following statements about survivorship life insurance are true, except
Policy facing on is paid out only upon the death of the first insured to die.
do you know this one, Sean? Are you familiar with these policies?
Not quite familiar.
Okay, no worries. That's why you're here. These are called estate planning policies. The estate planning policies are usually for the affluent community. They're buying these policies to pay Uncle Sam because when they die, their families have 9 months to submit their estate tax to the government. Now in California, only our federal government charges the estate tax. And right now, the exemption, I believe, is 15 million. Don't quote me. I think it went up for 2026. So I think it's 15 million. And then if you're married, it's times 2. So these estate planning policies, remember that agent I told you about that I was being very nosy and looking at
Yep.
his leaderboard there? He was selling these. So they're written in excess of $1 million. It's 2 lives on one policy, but it'll only pay out 1 time. Therefore, it's less expensive. There's 2 types of estate planning policies that you'll see on your test. The first one's called joint life. Some typos here, but let me tell you what it's supposed to say. On joint life, mom and dad are both on the policy. Mom dies, the policy will pay. So it pays upon the first to die. Okay? Pays upon the first to die. So first in time dies, they're going to pay. Have to make it work out there. Now, dad's left with no insurance. So dad, you got to know, can convert that policy to an individual policy without proof of insurability because he proved insurability when he purchased the policy in the application phase. Okay? Therefore, he does not have to show proof again. Survivorship life is different. Under survivorship life, mom dies, it does not pay. Why not? Well, because they didn't need it to pay. This was for the sole purposes of paying Uncle Sam. You see over here, the reason why they had it pay upon the first to die was because when mom died, it affected dad's ability to care for the children, right? But over here, it didn't, because when mom died, it did not affect the mother's ability. Sorry, when dad died, it did not affect the mother's ability to care for the children. Why not? Well, maybe they had a business. Over here, maybe they were paper rich, cash poor. But over here, they had a business that was bringing them income. So they didn't need a policy to pay when one of them died. So strategically, they said, look, this money is for Uncle Sam. So let's buy a survivorship life policy that pays upon the second to die. Make sense?
Yep.
But when we go back here and we see all the following statements about survivorship life is true, except pays upon the first to die is wrong because that's joint life. This pays when the survivor dies. Make sense?
Mm-hmm.
So you can see again, the policy amount is usually more than $1 million, offers premiums that are quite low compared to what you would pay for 2 separate policies. And it is particularly well suited to meet the needs of estate taxes. Exactly what I said, right?
Yep.
All right, term insurance is typically characterized by what? By what? Which one?
Low
Okay.
premiums and
Low
no cap.
premiums. Okay.
What happens when you read too fast? I got to slow down. The key word there again, no cash value, right? Term, no cash. Low premiums, no cash. I went over this one really quickly earlier. The adjustments that the insurer makes on a cash value account in the universal life policy each time a payment is made includes all of the following except
Track the policy surrender charge.
when will they subtract surrender charges, Nicole? Words mean what they say. So when will they subtract surrender charges? Hmm? You're muted. Nicole, you're muted, so I can't hear you.
I said I have to read it to myself sometimes, so that's what I was doing.
So the
Uh,
question, so the question is, when would they subtract surrender charges?
the adjustment that an insurer makes in a cash value account subtract surrender charges in a universal life policy each time a payment is made includes all of the following. I don't know.
So this is saying except surrender charge. They're not going to subtract surrender charges. Every time you make a payment, they don't subtract surrender charges.
Right?
When would they subtract? When you surrender. The
Oh,
only
right. I
right?
overthought it. I was thinking of it more technical than that. That was super simple, but I was thinking way, yeah.
So it helps you understand this one that they're not going to subtract the surrender charges every time you make a payment. That's silly,
Right,
right?
right.
They're going to subtract surrender charges when you surrender the policy because words mean what they say. Got to keep it simple. All right, which of the following is a correct statement about life insurance policy types?
Initial premium for term insurance is lower than the initial premium for whole life insurance.
Make sense? Initially, yeah, term is really inexpensive. But don't remember this where it gets really expensive. That's something just confuzzle you. But the initial premium is low. Yeah. Term insurance differs from permanent insurance in that term insurance,
Builds no cash value and pays a death benefit only.
remember the key word, no cash value. Specified period of time. When cash value equals a face value policy, what occurs?
Endowed.
Another way they'll say that, it matures. What type of policy has a principal insured cover with whole life policy and term on the spouse and child?
Family policy.
Persistency is important for all the following reasons except
Each year the policy is in force, more insureds will use the benefits.
renewable term can be best described as what?
Death benefit with an increase in the premium.
That insured bought a $150,000 non-participating policy many years ago. He's 100 years old today. He has never borrowed from the cash value and has made his faithfully his payments when due. The policy's cash value is
50 grand.
150, 150. Remember, if they say that he paid it up already at age 100. An individual with low income and high insurance should buy what? All the following statements about survivorship life are true except,
The policy facing on is paid out only upon the death of the first insured to die.
I kid you not, all these that are being repeated, remember there's 10 questions on life policies. All the ones that are being repeated, there's a reason why it's being repeated. And a lot of times students come back and say, I got these on the test. The adjustments that the insurer makes in a cash value account in a universal life policy each time a payment is made includes all the following except,
Subtract the policy surrender charges.
which of the following is a correct statement about life insurance policy types?
Initial premium for term insurance is lower than the initial premium for whole life insurance.
An applicant has purchased a $500,000 home. He is currently paying $1,500 per month for his 30-year mortgage. That's a lot of blah, blah, blah. In order to protect his beneficiary from paying the mortgage upon his death, which of the following should he purchase?
Decreasing term.
Make sense?
Yeah.
A $50,000 whole life policy with a cash value of $10,000 has been enforced for 11 years. The policy owner is unable to continue the premium payments. Which of the following describes the reduced paid up non-forfeiture option?
Cash value is the purchase of 20K paid up policy.
So looking at the handout that I texted you guys and the one that my friend Cheyenne has, Look at the bottom left corner. On the bottom left corner of the acronym sheet, it looks like this. Okay, you guys see it? Bottom left corner in that text that I sent you is the NFDS chart. Okay, that NFDS chart I said accounts for about 20 possible questions on your test. This is one of them that's commonly on the test. The non-forfeiture provision says that the cash value in that permanent policy will not be forfeited. How do you want your money back? Okay, so this right here is the NFDS chart on that chart written out. So, I mean, it has it written out here, but this has a little bit more details. So I always say care.
Yellow, right? It's like highlighted in yellow.
Yes.
The non-forfeiture policy, dividends, and settlement options.
Yes.
Okay.
Yes. They like to collapse it and they'll be like, all of the following are settlement options except, all the following are dividend options except, which of these is not a settlement option? So you have to know which one is which, okay? So the non-forfeiture option protects the cash value grown in permanent policies. If the client can no longer afford the premium payments, they can surrender the policy and take the cash. In the book, it shows you like a table of guaranteed values. That's where we got these numbers from, okay? Now, APL is not a non-forfeiture option, but it's a way to keep the policy alive. APL kicks in, state exam answer, after the grace period. Everybody gets a grace period. Reduced paid up means they're going to reduce the death benefit, but the policy is paid up, no more premiums. They take the cash value and they buy another policy with a reduced death benefit, and there's no more premiums to pay. It's like a single premium whole life that they're doing.
I'd say that's like what that is. Right?
But it's not a MEC because they're using a non-forfeiture option to do it. Extended term. They're going to extend the death benefit, but only for a term. The 16 years and 88 days is what it was calculated in the table of guaranteed values. Now going back to this right here, looking at this answer choices, the cash value is used to purchase $50,000 term that is paid up for 10 years. Which non-forfeiture option is that, Sean?
Sorry, hold on. Do you want me to read it? Read this one?
This number 4?
Yeah.
Which non-forfeiture option is that?
The cash value is used to purchase a $50,000 term policy that is paid up for 10 years. Decreasing whole life? Or decreasing term life?
It's a non-forfeiture option.
Got it.
So which one is it? Which one of these is it?
Cash surrender?
I'm gonna give you a hard time.
Cash value is used to purchase a
Words mean
50,000
what they say. Look, read this one. What does it say?
policy is surrendered and the policy owner is paid 10,000 by the insurer.
Which one's that one?
The surrender.
Yeah, that one's cash surrender, right?
Yeah.
Because words mean what they say, right, Sean?
Yeah. So cash value is used to purchase. So I think I'm just confused on like which ones there are. So if I'm looking at the chart, the left side, cash surrender, automatic, reduced paid, extended term, would this be the
Yeah.
reduced paid?
That's great.
The one that you just read, the cash value is used to purchase a $20,000 paid up policy. That's the reduced paid up option. That's exactly
Right.
why they answered, right? But the one that I asked you for originally, the cash value is used to purchase $50,000 term. 50,000, they extend the death benefit,
So
but only
extended term.
extended term.
Yeah.
Do you see how words mean what they say?
Yeah, totally.
Remember, take the emotion out of this conversation. The moment you take emotion out, even me putting you on the spot gives you some emotion, right? But if you take the emotion out, then you can think, Nicole, when you're at the test tomorrow. You've got to say, you know what? What I know is what I know. I'm going to go in there and I'm going to just remember words mean what they say. And if you use that to guide you, you'll get through it. A lot of questions you'll be able to figure out just with words mean what they say. But also remember to dance in the conversation.
Yep.
All of these are non-forfeiture options. I want you to read the first one right here. Read that out loud for a minute.
The policy owner begins to receive $200 monthly payments from the insurer that will continue for life.
What do you think that is? Look at your chart. What is that?
Automatic premium loan.
No. Read it again.
Policy owner begins to receive $200 monthly payments from the insurer that will continue for life. Extended term.
Look at all of in the whole chart, the NFDS chart. Look at all of it. Look at all three columns. There's a key
Oh,
word in there.
life income.
Yeah, it's a settlement
Got it.
option.
Settlement option. Yep.
So they threw a settlement option in there to throw you off.
I got to study these. So this table, this is
Right
what,
here.
like,
This is the same as what is in that little chart, but a little bit more details. A non-forfeiture option protects the cash value. So again, permanent policies that have cash value, if the client can no longer afford the premium payments, how do they get their money out of that policy? They can surrender the policy, take the cash and run. They can say, you know what, use that cash value and I want to get a new policy that the death benefit's reduced, but I don't want to make any more payments. Or look, I really want the 100,000 for my family. Just extend that death benefit for a term.
got it.
Make sense? Now, dividend options, again, words mean what they say. They're paid out annually on the anniversary date of the policy. Dividends are determined by the actuaries. Remember, when they create premiums, it's projected mortality, projected interest, projected expenses. When a dividend is determined, they're looking at dividend, by the way, the acronym is DIME. The dividend is determined by looking at actual interest, actual mortality, and actual expenses. So if a dividend is going to be paid out, the client gets to decide, okay, how am I going to get my dividend back? Am I going to get cash? Send me a check in the mail for that $200 dividend? Or is the client going to choose reduce my premium? Words mean what they say in all these, right? Or hey, put it in my cash value and let it accumulate interest. Nah, you know what? Use that $200 dividend and pay future payments called the paid up option. I pay my premiums this way, the insurance company's paying the dividends to pay my premiums this way, and we meet somewhere in the middle, right? That's called paid up option. And the next one's called paid up additions, which is the strongest dividend option out there. This is used to purchase additional slivers of whole life insurance that are paid up. Hence the name paid up additions. Additional insurance that's paid up. And there's a sliver of cash that is used, to buy that sliver of insurance, they're using cash. So you have that guaranteed cash value growth, and then you have a non-guaranteed element on top of it. And then the last one's called 1-year term, not very common, but if you see it, 1-year term is a dividend option. The way to remember your dividend options is to remember, oh crap. That's kind of how you're feeling right now, huh, Sean? Oh crap, this is bad. But if you remain calm, you can see where words mean what they say,
Totally.
right?
Yeah, just got to read them through. It makes sense.
Yeah, now settlement options, remember, settlement options, how they're going to settle the death benefit. How are they going to pay out your beneficiaries? If no settlement option is chosen by the policyholder, then default is lump sum. Here's your $1 million, enjoy. Or they'll allow the beneficiary to choose a settlement option. Why would the insurance company do that? Because if they can hold on to the money in their account and make money on your money, they're more than happy to allow you to keep your money in their account, right?
Right.
And then they'll pay you out in payments. Now, the first option is life income, income for life until the beneficiary dies. These settlement options are also true for annuities. It's how an annuity is created. They can take that death benefit and create an annuity with it, right? Based upon the age, the gender, and how much is being paid out will determine what the income is. But if I'm getting an income for life until the day that I die, that's called the life income. There's sub options because some people didn't like the fact that after I died, after 5 years, game over. So they created the life income with period certain. On your state exam, You're tested on that 10-year period certain in so many different ways. A 10-year period certain means that they're guaranteeing 10 years of payments to your beneficiaries if you die before the 10 years is up. If you die on the 11th year, game over, your family gets nothing. But if you're living to 120, congratulations, Nicole, because you are going to get a lot of money, right? Until the day that you die. Great opportunity. So when you see the annuity questions, you're going to see that the annuitant receives for 5 years, then dies. What would the beneficiary receive? The answer is 60 months. Well, how did they come up with 60 months? 5 years times 12, 60. More sub options here. You'll see them in the playbook. Just remember, life income with 10-year period certain, life income with 20-year period certain. Straight life income comes with no guarantees, which will give you the most income. Okay. This is now a different choice. I can pick interest only, right? So I can say, you know, my daughter, she's not very good with money. So if I leave her $1 million, it's gonna be gone pretty quick. So you know what? Just give her the interest. I just want to make sure that the money is there for long term. So let's do 20 years interest only. Now, can they take money out? There's provisions in there where they can take some of the money out. But if I say interest only for 50 years, it's interest only for 50 years. She won't like me, but at least in 50 years, she'll have some money in there, right? Fixed amount. So let's say, you know, Sean, you just want your wife to have like 10,000 a month until the money's gone. She doesn't need any more than that. Or you may say, you know what? Take the $1 million and pay it off in 10 years. Make sense?
Yeah.
So you get to choose. Words mean what they say. Now, under fixed amount and fixed period, does the beneficiary get more than death benefit? Let me slow down. Does the beneficiary get more than the death benefit?
No.
Less than the death benefit? Same as the death benefit, or cannot be determined?
It would be same as the death benefit.
You got tricked, Sean. Always more. Why more, Nicole? Do you know why?
The interest.
Yes, whenever the
Got
insurance
it.
company holds the money, they're going to make money, so they're going to give you a piece of it. They're going to give you interest. Hence the interest only option that's available as well. So they'll give you the fixed amount, the $1 million plus interest that has accrued, right?
That makes
And
sense.
until the money's gone.
A quick
And fixed-
question.
Yeah.
When those policies that we were talking about, like front loading the policy, those ones also get interest and probably a little bit more because you're front loading it, right?
That's a whole different conversation. We're talking about how the death benefit's being paid out, but you are right on when you front load it on that, you are going to make more money.
Okay.
So that's why the premiums overall are less. The actuaries determine, you know, because you're front loading all those premiums, overall ends up being less, but you're taking, let's pretend 70 years of payments down to just 20 years, your premium will be a lot higher. Make sense? So these are your non-forfeiture options, dividend options, and settlement options. Remember, there's no L in care. Okay? Remember, there's no L in no crap. They love to collapse these. You have to know your NFDS chart. Okay? All right. So moving along, we don't need family maintenance. We don't need family income. What flexible policy can offer a guarantee of mortality and expenses?
Universal life.
Universal.
Thank you. From the descriptions below, which one best identifies a term policy?
Each year, the premium increases as the insured grows older. After several years, the coverage and premiums ends simultaneously. There is no cash value.
My key is no cash value. The settlement option that pays proceeds to 2 or more people and ceases upon the death of the first is known as, and this is the same thing as the joint life that we talked about, pays upon the first to die, right? Death upon the first joint life. So it is a settlement option called joint life as well, and it works the same way. All right. I think we had more questions on this side, didn't we? All right, couple. The type of universal life plan where the fixed interest rate of the cash value is replaced by another, which permits the insured to choose from a variety of investment vehicles, is known as which of the following?
Flexible premium, variable life.
Yes, remember, universal life has flexible premiums. That's the keyword for universal, flexible premiums, and it's variable because they get to choose the investments. This is an annuity, so that's not it. It's a life insurance policy. And then variable life is fixed premiums. That's why it's not this one. You have to go for flexible premium variable. This is probably one of the harder questions on the test, to be honest with you. Make sense? All right, in your playbook, the answer for this one is 21. You heard me yesterday or Saturday talking to them. If 21 is not a choice, you got to go for 18. Okay? But 21 is a first choice. Which of the following policy pays upon the second to die?
Survivorship life,
Thank you. So which one would pay upon the first to die?
the joint life. Now,
This is probably the most easiest question on your test because words mean what they say. Decreasing the premium will increase the cash value? No, that's not true.
Decreasing the face amount will cause premium to decrease.
So I can adjust an adjustable life, I can adjust the death benefit, right? Or the premium, but it's going to change. If I reduce my premiums, it doesn't increase the cash value. It's going to reduce my cash value. That's supposed to grow. Make sense? All right. I think we said this one's really important to remember. Which of the following is not true regarding a mech?
Issuing a MEC is a violation of the state insurance code.
Remember, it's not. That's why I told you the story about that agent that sells it all day long, right? You guys remember this one? Measuring gauge used to establish persistency and stability of a group is what?
The size of the group.
Yeah, the size of the group. Good job.
Persistence.
All right, listed below are descriptions of 4 policy types. Which is term? I'm looking for that keyword. What's that keyword I'm looking for? Specified period of time and no cash value. Where is that?
The policy premiums must be paid 20 years afterwards. The policy continues.
Number 4.
Good job. Yep, that is right. No cash value. All the following answers are used when using the human life value except. Oops, sorry, wrong
Education?
one. Sorry, thank you. Sorry, there's a lot of billionaires out there that don't have a college education. I messed that one real quick. Good catch. All right. So we got through the first 3 chapters. Not bad. We have more, but I know you guys are probably done. D-O-N-E, done.
I can go a little longer.
You ready? I can go. You're ready.
I
We
gotta
don't have-
jump, but Nicole, good luck on your test tomorrow. You're gonna crush it. And then Jackie, I will see you tomorrow evening.
Tomorrow evening. And let's plan. Can you plan for till 10? Or do you
For
want to do
tomorrow?
9? Actually, just you and Cheyenne. So what if we plan till 9 and then we add Thursday just to be safe as a backup? Do you have time Thursday?
I think so.
Okay, let's plan for Thursday then.
Okay.
Okay,
If
cool.
anything happens tomorrow, I'll text you. But yeah, I should be good.
Yeah, if you can't make Thursday, we can change it to your test is on Monday?
It's next Monday, yeah.
Morning or afternoon?
10:30 morning.
Oh, wow. Okay. Yeah, it's the playbook, it's all in there, but just kind of
Honestly, I'm doing it remote, so I can change it too. Like it's not there was more availability. So I was gonna take some practice tests towards the end of this week, and like if I started bombing them, then I'll move it.
Well, what I would recommend is you don't test yourself first. And
Okay.
then what I would do, what I can do is I want to send you I'm going to send this to Nicole too, is the video that I sent to Galen, which was like the updated questions that we had. It's on YouTube, but I'm going to take it down in a bit. So
Okay.
if you want to just take a listen to that, it's a good 50 questions on just the updates, like how they're asking it, how they've changed it, just so they can
Perfect.
dance in the conversation.
You
Uh,
said don't take a practice test?
the more you test yourself, the more you start analyzing. Like, just ask yourself, does this sound familiar? Do I remember this? Because
Yeah,
it's a repetition that's going to get you to retain it, right?
that makes sense.
And it's all in the playbook. But if you really are head set on doing one, I'll give you one, but do the one I give you. Don't start searching everywhere for tests, because what tends to happen is you start second guessing yourself, like, and you stop not trusting the playbook. And I guarantee you everything's in the playbook.
Just to add on to what you said, I took this class 5 years ago. Didn't pass the test. Like I said, I had some things going on in life, just wasn't
Yeah.
focused, wasn't there. So here I am again. So what I can tell you about the test and this material in this class is very similar. What I'm going to tell you also is that the insurance company that I signed up with, I did which would have been 52 hours, is now 12 hours with them. And they have like a material that you're supposed to go over. It's so far away from the test and it's so far away from this material. So what
Yeah.
she's saying about following their material is actually very accurate.
Okay,
Yeah.
good to know.
And do
Yeah.
you have that 12 hours done already, Sean?
Not done yet. No, I'm like a quarter of the way through.
While this is going on tomorrow, just throw it on so you can have it on
Okay.
the side listening to, like, because there's time requirements. I would put a timer for 20 minutes.
Literally, that's what I'm doing. I have one more hour of my 12 hours because I had to reset them and they have
Yeah.
been running on another computer while I'm doing this.
Yeah, and don't worry about that at this point. Make sure you just set that aside, and then after you pass your test, finish that last hour.
Then you
Because
can
I want
finish
all
it and
you,
then do it after.
yeah, just don't apply until your hours are done. But have that on
Okay.
the side when you're studying, is what I would recommend.
Okay.
Yeah, for sure. Especially we covered a lot of
Perfect.
the code ethics. I mean, there were some things that we didn't cover, like the commissioner is elected for the people, by the people, for the people, for a 4-year term, like the governor. There's little things, shall and may, that we learned about in the cram course, but yeah. Did you guys get the link to the YouTube?
Yeah, I got it. Thank you.
Okay, cool. Yeah,
Did you
and I mean,
text it or did
it
you?
was way more focused than the daytime. So hopefully I mean, they were guessing at it. Galen said she had a hard time seeing the board because it's the YouTube. So just zoom in. You can zoom into the board and you can see the board clear that way. Okay.
Okay.
All right.
Thank you
And
so
so
much.
you're
Good
welcome. I'll
luck
see you tomorrow.
again, Nicole.
Thank you, and good luck for you next week also.
Thank you. All right. Take care,
Good night,
guys.
Sean.
All
You
right,
too.
good
Good night.
night.
Bye.
And Nicole, we'll do this and then we'll see how you're feeling. Okay.
Okay.
All right. So some policy provisions it's actually chapter 4. I'm not sure why they have both of them, but that's okay. The effect of the incontestable clause on life insurance policy serves which purpose?
It prevents the insurer from voiding the contract on grounds of misrepresentation, concealment, or fraud of the insured if he or she dies after the period stated in the what?
Policy. In the policy. Even if you didn't see that, you could probably figure out what it was. All right, remember it's 2 years. Yes? 2 years. All right. Once a policy is lapsed, the policy owner can typically reinstate the policy if proof of insurability is shown. All back premiums plus interest have been paid in less than what amount of time?
3 years.
An unpaid life insurance policy loan may void the contract if the amount of the outstanding loan plus interest exceeds what?
Cash surrender value.
When these are coming up, is it coming back like, oh yeah, I know this?
Yeah, so I know that cash surrender value one, I know that because if the loan exceeds it, basically you've lost your money in it. So that's why it's the cash surrender value.
Yeah, it implodes. But did Irma go over it?
I think I just kind of knew that from just life. Yeah.
So when you see something that you remember, it's important to use your affirmations to be like, yeah, I got this. Oh, wow,
Yeah.
this is, because you're affirming it and you're building your confidence. So when you go in there tomorrow, you're like, yeah, I got this. This is easy. All right. Which of the following is true about life insurance policy loans?
They may be borrowed against cash values at a specific interest rate.
Cheyenne's letting you say it for him. Come on,
Oh.
Cheyenne, bring it. No freeloader, Cheyenne. Do you have to be back home by a certain time? Okay. Okay. The grace period in regards to life insurance policy is the time allowed after the date in which to do what?
Pay the
Pay the
premium.
premium, no penalty or evidence of insurability is required.
Thank you. Which of the following statements describes the effect of the suicide clause found in life insurance policies?
If the insured dies by suicide within 2
Outside
years,
of 2 years from the date.
liable only for return of premiums paid.
That was the one I was talking about earlier.
What makes up the entire contract in a life insurance policy?
Policy.
Policy when attached to the application.
If the insured dies by suicide within the time limits of the policy issue date, the company is,
Liable for the return of premiums paid.
and we've seen it so many different ways, so that's like 3 questions on suicide clause. You think they want you to know about suicide clause? For sure. How may a life insurance policy be reinstated within time limits after it has lapsed from non-payment of premiums?
By paying
Paying overdue premiums plus interest with an application of evidence of insurability.
Good job. See, you were able to finish it, you didn't even have to see it. Good job, Nicole. Hey, just a quick reminder, where would you find how to reinstate a lapse policy? And the answer is in the reinstatement provision, because words mean what they say. When the owner of the policy, of a life insurance policy, assigns the entire face amount to another, it's known as?
An absolute assignment.
The key is the entire face amount. Every collateral is usually a partial assignment. Okay.
Right.
If suicide occurs during the suicide restriction period, the insurer will
pay an amount
Pay an amount equal to the total payment. That's so funny. They just said that 3 different ways. Say that.
right
Yeah.
dance in the conversation. I love when that happens because then you can see how they're going to play with you. When does an agent have the authority to change policy provisions?
An agent
An agent never has the right to change any part of the policy.
What provision allows the policyholder to transfer the entire value of the policy?
Absolute assignment.
Thank you. The policy provision that prevents an insurer from voiding a policy for misstatement after 2 years is?
Incontestability clause.
The 30-day grace period means that?
Policy
remains in force up to 30 days beyond the lapse premium.
Who is entitled to receive the death benefit in the facility payment provision?
The nearest living relative.
Remember I shared with you that you got to be very careful because of the fact that it is, you got to be very careful because in real life, like, you're gonna have a primary beneficiary name, and if you don't, again, nearest living relative, what do they mean by that? You just gotta go for it, okay? It's in a group policy, that's why they're saying that. All right. What makes up the entire contract? We saw that already.
The policy when attached to the application.
All right. The grace period in a life insurance policy is the time allowed after the due date for which what must the insured do?
Pay the premium.
No penalty or evidence of insurability is required.
Make sense?
Mhm.
An automatic premium loan is made when?
At
the end of each grace period.
Persons involved in viatical settlement. What provision in the life insurance contract allows for this transaction?
Absolute assignment.
Thank you. The insured is totally and permanently disabled. The insurance policy continues in force without the payment of a premium because the policy contains
a waiver of premium.
Because the words mean what they say, right?
Mhm.
While an insurer is paying the premium for a life insurance policy under the waiver of premium rider, which is true.
The policy remains in full force in every respect.
When does the agent have the authority to change the policy provisions?
It never has the right to change any part of the policy.
Makes sense. If the insured's death is the result of a suicide during the suicide restriction period, the insurer will
pay an amount equal to the total premium paid.
All right. From the choices below, which party has a right to borrow from the cash value?
The policy owner.
What would prevent the policy owner from taking a loan out of the policy?
If there was no equity built up in the policy.
Then fulfill the 30-day renewal.
The irrevocable beneficiary doesn't agree. when the irrevocable beneficiary is listed, they now have a vested interest in that policy that nobody can impair without their permission. So
Got it.
the irrevocable beneficiary doesn't agree, then that's one way.
Got
Make
it.
sense?
Yep.
Alrighty, let's talk about beneficiary designations here. All right, the preferred way to name the insured's children as beneficiaries and to assure that all such children are provided for equally is to do what?
Use a class beneficiary.
Use the class beneficiary designation.
When the policy owner has named Betty Smith as an irrevocable beneficiary, what does or does not need to take place?
The policy owner can borrow the loan value of the policy only with Betty Smith's permission, what we just talked about.
Make sense?
Yep.
A life policy may restrict payment of proceeds to a beneficiary such that
It may do any of all of the following above. Wait, it may
which
do
is
all of the above. Oh, it may provide the beneficiary can't transfer them. It may provide that the beneficiary can't incubate them. It may provide that the proceeds can't be subject to the claims or creditors or any legal process against the beneficiary.
make sense?
Hmm?
Does that make sense?
Yeah, I thought you said fix it. I was like, huh?
That's a spendthrift trust clause that protects it against the creditors.
Yeah.
How do rights of an irrevocable beneficiary differ from those of a revocable beneficiary?
A irrevocable beneficiary has a vested right that neither the policy owner nor his creditors can impair without the beneficiary's consent.
Make sense?
Yep.
Keyword is vested right.
Yeah, that's why I kind of emphasized it.
Yeah. What is the main purpose of the common disaster clause in the short-term survivorship?
They preserve the amount the secondary beneficiary would collect from the policy.
It's to protect the contingent or secondary beneficiary.
Mm,
Make sense?
yeah.
All right, we already saw that one. Okay, all the following statements about contingent beneficiaries are true except
The contingent beneficiary shares death proceeds equally with the primary beneficiary.
remember it's never equal.
Right.
They pick up where the beneficiary died. They receive the remaining, yes.
Mhm.
They receive the death benefit if the primary dies before the insured. And yes, there may be more than one contingent beneficiary named, but they never share it equally. Make sense?
Yep.
How do rights of an irrevocable, we already saw that one. We're gonna skip through that one. Ooh, that one came out a lot too. Okay, all right. The Uniform Simultaneous Death Act protects the,
Contingent secondary beneficiary of the insured.
remember that's a common disaster clause. We see it again, policy provision which comes into effect when the insured and primary beneficiary die in a simultaneous accident with no evidence of who died first is known as?
Common disaster clause.
Thank you. When the policy owner wants to change a beneficiary, who has to sign on an irrevocable beneficiary?
The insured.
The insured and the irrevocable beneficiary agreeing together.
Remember, if it says revocable, then you don't have to worry about that, okay? All right, these are the writer questions. There's only 4 writers on your test. That means if I show you all these, you better get 100% on those writer questions. Accidental death benefits provides an additional payment when the insured dies within a stated time after as a result of an accident. Generally, the insurer will pay what amount?
Double the face amount.
So remember, another name for the accidental death benefit is your double indemnity, okay?
Mhm.
All the following are true about life insurance policies which have a waiver of premium with disability income rider attached,
The
except
cash value.
Cash value is used to pay premium during a period of disability.
that's a waiver of premium, right? And the cash value is not used. The insurance company pays it as if you were, it's waived, right? The guaranteed insurability option provides the ability to do what?
Purchase additional insurance regardless of insurability.
Now remember, all these are right answers for a different question. Double the amount of the death benefit in the event of an accidental death is your accidental death benefit rider.
Mhm.
Access a portion of the death benefit in the event of a serious illness. That's your accelerated death benefit option rider, sorry. Waive premium payments in the event of a disability. What is that? Waiver of premium rider. Words mean what they say. The answers in the questions in the answer, Nicole. Don't let them trick you, okay?
Gotcha.
Which of the following gives individuals a right to purchase additional life insurance regardless of their insurability, regardless of their insurability, no medical exam is required.
Guaranteed insurability.
Yeah, we can connect this one to number one. We can connect this one to number two, right?
Yeah.
Because words mean what they say. The insured is totally and permanently disabled. The insurance policy continues in force without the payment of a premium because the policy contains what?
Waiver of premium provision.
Which provision will pay a portion of the death benefit prior to the insured's death due to a serious illness?
Accelerated death benefit.
Yep. Accelerated death benefit.
Remember, they can save terminal illness, same thing. The guaranteed insurability option provides the ability to
Purchase additional insurance regardless of insurability.
keyword insurability, insurability. Okay. They may say without proof of insurability, right? That's same.
Mm-hmm.
The payer rider on a juvenile policy provides that if the payer dies or becomes disabled before the insured the insured juvenile reaches the age specified on the policy,
The insurer will make the payments until the insured juvenile reaches a specific age.
thank you. The insured is totally and permanently disabled. The insurance policy continues in force without the payment of premium because the policy contains what?
A waiver of premium.
We saw that a minute ago. Ooh, common life insurance policy riders include all the following except
Extended term.
what's extended term?
Oh, it's a non-forfeiture option.
See how they try to trick you? It's not a rider.
Well,
It's not a rider. What'd you say? Yeah, our NFDS chart.
Still gonna understand those.
While an insurer is paying the premium for a life insurance policy under the waiver premium rider, what is the case?
the policy remains in full force in every respect.
Makes sense?
Yep.
The insured is totally and permanently disabled. The insurance policy continues in force without the payment of a premium because the policy contains what?
Waiver of premium.
Waiver of premium provision.
Man, you think they want you to know about this waiver of premium provision? Absolutely. We see it again here. Cost of living rider on a policy will provide what?
The
Base
base amount of the contract will increase according to the increases of index for additional premium.
Yeah, and they'll say CPI. CPI stands for your consumer price index.
Okay.
And you do pay an additional premium. They're trying to trick you and say that you don't pay a premium. You do pay a premium. The rider, what you pay for the rider is just for the option to increase your coverage. Make sense?
Yep.
And again, we're seeing this again, but that's okay because repetition is the mother of all learning. So which provision will pay a portion of the death benefit prior to the insured's death due to a serious illness?
Accelerated death benefit.
And the accidental death benefit rider is also known as what?
Double indemnity or double the face amount.
At what age does the youngest child, at what age of the youngest child does the blackout period begin?
18.
18.
The client purchased $1 million whole life policy at age 24. She added a rider to the policy that allows her to purchase additional amounts of insurance without evidence of insurability. And it gives you the stated ages. Which rider did your client buy?
A guaranteed insurability rider.
Because words mean what they say. What do you think? Easy peasy?
Yep.
All right. Here's our NFDS chart. Which of the following is true about non-forfeiture provisions?
Protect the cash
Protect
value.
the cash value accumulated in the policy.
When an insured surrenders the whole life policy and selects extended term insurance as the non-forfeiture option, the cash value will be used to buy what type of coverage?
Level term insurance in the same amount as the surrender policy.
If your client buys a 30-pay whole life policy for $35,000 at age 20, and then the policy lapses later, the non-forfeiture option that would provide protection for the greatest length of time would be which of the following?
A reduced paid up option.
Make sense?
Yep.
On August 12th, 1975, your client purchased an endowment at age 65. On April 1st, 1986, she converted the policy to a reduced paid up status. The amount of the life insurance she has under the policy is equal to which of the following?
Face amount of
The face amount of the paid up coverage less than the original policy's face amount.
That makes sense, right?
Mhm.
Yeah.
So reduced paid up. A $50,000 whole life policy has a cash value of 10,000, has been enforced for 11 years. The policy owner is unable to continue the premium payments. Which of the following describes the reduced paid up option?
The cash value used to purchase a 20,000 paid up policy.
Reduced 50,000 to 20, reduced, and it's paid up because words mean what they,
Say,
thank you. And we saw this already. Common life insurance policy riders include all the following except
extended term.
Extended term.
an unpaid life insurance policy loan may void the contract if the amount of the outstanding loan plus interest exceeds.
Cash surrender value.
Cash surrender value.
Common life insurance policy riders include all the following except.
Extended term.
Extended term.
All right, moving along up to our dividend options. Which of the following is, which is true about policy dividends?
Cannot be guaranteed.
Cannot be guaranteed.
Thank you. When the policy dividends are used as a single premium to buy additional life insurance, what is this option called?
A paid up addition option.
Which answer is true about policy dividends that have been left to draw interest?
They can be used without affecting the value of the policy.
Now, that's a harder one, I think.
Mhm.
That's okay. Which of the following policy dividend options will allow the policy owner to withdraw money without affecting the cash values of the policy?
Accumulated interest option.
So again, this one they tell you about it. And this one they tell you what it's called.
Mhm.
Uh-oh. One of the following is not a dividend option of a participating life policy. Which answer is it?
Receiving the cash
Receive
surrender.
the cash surrender value.
What's the cash? It's a non-forfeiture option, right?
Mhm.
You have paid up addition. Oh crap. Reduce my premiums, right?
Yeah.
All right. Paid up additions are.
Dividend options.
Which of the following statements about policy dividends is true?
Cannot be guaranteed.
Never guaranteed. Which of the following is true of policy dividends?
Not be guaranteed.
Saying the same thing, just another way. Yeah, look at that. Paid up additions are what type of policy option?
Dividend options.
Ooh, let's talk about our settlement options. An insured who wishes to receive a retirement benefit which cannot be outlived by either the insured or the primary beneficiary should choose a life insurance policy with which option?
Joint and survivor option.
When the principal never decreases until the beneficiary withdraws it, this settlement option is called.
Interest option.
If either the fixed period or fixed amount option is chosen, which scenario occurs?
Total amount paid.
Total amount paid over the years will be more than the face amount of the policy.
Always more. You had it right because of the interest, right?
Mhm.
The settlement option that pays out a predetermined monthly benefit until principal and interest are exhausted is known as what type of option?
Fixed
The
amount
fixed
installment.
amount installment option.
Fixed amount, right? Predetermined amount. Did I say words mean what they say?
Mhm.
See that, Nicole?
Yep.
Are you sick of hearing me say that? Have I brainwashed you enough?
You have.
Did Irma say it too?
No. Well,
Oh.
yes, she did. She said that. What she didn't say is dance in the conversation.
Oh yeah, dance in the conversation is really important. You can see why. I mean, it's clear.
Mhm.
Clear as day. All right, all of the following are classed as settlement options for paying life insurance proceeds, except.
A lump sum payment.
A lump sum payment made to the beneficiary.
Yeah, remember, lump sum is default. If no settlement option is chosen, then default is lump sum, but everything else is a settlement option. All right. William has chosen a policy under which the company will pay his widow an income each month for as long as she lives. Payment stops at her death. Option William has selected.
Life pay.
It's straight life insurance.
Yeah, with
I mean,
no
I'm
with
sorry.
no sub options. There's no sub. All these are sub options, right? There's no sub option.
Wait,
If
quick
you-
question, Jackie. So you guys are getting back on here at 9 a.m.
No, tomorrow night.
So
6
9
to
p.m.
yeah.
Okay,
Yeah, for the health side.
got it.
Yeah. All right. William has chosen a policy. Well, we talked about that. If either the fixed period or fixed amount option was chosen, then what occurs?
Total amount.
The
paid
total
to-
amount paid over the years will be more than the face amount of the policy.
Awesome. All the following statements about election of a life insurance policy settlement options are true except.
When no settlement option is chosen, the proceeds are automatically paid to the policy owners.
That's probably the hardest question, I think. You have to remember that if you don't choose a settlement option, remember we said lump sum is default. Doesn't
Mhm.
get paid to the policy owner's estate. That's silly.
Right.
Remember, yeah, the beneficiary will be able to choose one if no settlement option was chosen because they
Right.
want to be able to hold that money.
And in group
What is
life
it?
goes to the nearest relative, right?
What?
And in
Oh,
group
yeah.
life goes to the
Yeah,
nearest.
they
Okay.
say, yeah. What is the purpose of settlement options?
Provide methods for distributing policy proceeds.
Control them from the grave. The settlement option that puts the insurer in the position of the least guarantee, which also has the potential to generate the greatest return to the policy owner, is known as what?
Life income option.
Yeah, there's no guarantees to the policyholder or to the beneficiary. This doesn't give them the most money. The settlement option that pays the policy proceeds to two or more people and ceases upon the death of the first is known as what?
Joint life.
Joint life.
All of the following statements about the election of life insurance policy settlement options are true except.
When no
When
settlement.
no settlement option is chosen, the proceeds are automatically paid to the policy owner's estate.
None of that, Nicole. That's contagious.
Oh.
The settlement option that pays a predetermined monthly benefit until principal and interest are exhausted is the.
Fixed amount
Fixed
installment.
amount installment option.
If either the fixed period or fixed amount option is chosen, then which is true?
Total amount.
The
paid
total
to-
amount paid over the years will be more than the face amount of the policy.
Thank you. All the following statements about the election of life insurance policy settlement options are true except.
No settlement.
When no settlement option is chosen, the proceeds are automatically paid to the policy owner's estate.
You can see how the playbook has a lot of repetition, right?
Yeah.
Settlement options are defined as which of the following?
Provide methods for distributing policy proceeds.
Remember, the settlement options are also the same for annuities. Settlement options that puts the insurer in the position of the least guarantee, which also has the potential to generate the greatest return to the policy owner is.
Life income option.
Ooh, wow. So those were your, and that was your NFDS chart. 20 possible questions on your test. Would you be ready?
Yeah.
Yeah.
Monday.
So this is the same. We just went over chapter 4, and I just broke up chapter 4 into these areas here. Chapter 5 is annuities and illustrations and taxation.
So this is gonna be going into,
Not a lot here. Let's do this, and then I think, where's your annuities at?
this is all of like general and life insurance, right?
There's your annuities. Ooh, worried me. What's that?
This is pretty much like all of general.
Yeah, we're trying to
Insurance, right?
through life insurance tonight. See how long
You
it
still
takes
have
me.
to-
I did. I probably should have like not done
Yeah,
general.
that's fine, like, it's a layover for tomorrow, so it's gonna help me retain it. I'm just hoping I'm retaining this stuff like in my mind, like.
Your job is to go through the playbook and make sure you review it.
I like
I mean, we're
it.
going over the concepts that are commonly seen for sure. Are you good to go? Are you ready to throw in the towel for the night?
I'm getting tired for sure.
Yeah. There's 10 questions on annuities.
Well,
Let's
keep going.
cover those annuity questions real quick, okay?
Okay.
Can we do that? All right, let's do these and then we'll work backwards to the other ones. When comparing a savings account and tax deferred annuity, where the savings account and annuity both offer the same interest on the same principal amount and same period of time, which will generate the return on investment dollars? Ooh, it doesn't have the answers, but let me give it to
The
you.
annuity
The
will be-
annuity will pay more because the tax deferred qualities.
Absolutely. Good job. All the following are true regarding the treatment of income tax on life insurance, except.
All of the following are true regarding the treatment of, okay.
Annuity.
For all taxation. No, I don't think that's generally exempt from, no. That's it. Annuity death benefits are exempt from all taxation.
Yep.
Oh, benefits, yeah.
Yeah, annuities, yeah, any interest is taxable.
When it's income, then the interest is taxable.
Yes. The
Okay.
exclusion ratio is used, remember?
Yeah.
Purchase an annuity addresses what risk?
Outliving the money.
I'll live in the money saved for retirement.
Joseph purchases a variable annuity and does not request the premiums to be invested in a stock or bond portfolio during the free look period. The policy is returned to the insurer within the cancellation period. What is Joseph entitled to receive?
The premium less
The
surrender charge.
entire premium. Oh, okay, go ahead. I thought it was the bottom one.
Without surrender charges, that's right.
No, sir. It's a free look period. He doesn't get
Yeah.
any surrender charges.
Within 30 days.
Make sense?
Yeah.
Upon annuitization of an annuity, proceeds are usually paid to whom?
The annuitant.
Yeah, it's the name of the person who owns the policy, right?
The insured.
Okay.
For those math questions.
Which of the following types of annuities will continue to make payments to a beneficiary after the death of the annuitant?
Period.
Oh,
surrender.
period certain.
Everything else is a pure life income, straight life, no guarantees on those three. Okay. You're going to see those again where the answer will be all of the above because it'll say which of the following will pay for the annuitant's life. All of them.
Mm-hmm.
A man has been diligent in investing money for his retirement. His total payments into his tax-deferred annuity are $100,000. He's now ready to take it out, and the insurance company that issued the annuity guarantees an annual payment for $8,000 for the remainder of his life. His expected payout over his lifetime is $200,000. How much of each year's annuity payment is taxable?
0.
It's
1,000 because it's
after tax dollars, so he's gonna be right. His total payments to tax deferred, so it's what he paid over. So it's investment over expected return times income. So if we do that, we simplify 100,000 to 200,000 is 4,000. Looking at the board for that one, right here, right? Well, 100,000, 200,000, 8,000, 4,000.
half of it is the interest. It doubled.
Yeah. But if they go and they play this game, they say 50,000 over 200, that's 1/4. Now it's 8,000. You subtract the 2,000 to get 6,000 if the question says what's taxable.
Mhm.
Remember, that's the exclusion ratio. What's excluded from taxes?
Mhm.
Investment over expected return times income will tell you what's excluded from taxes. Okay. Remember, on a non-qualified annuity, we use exclusion ratio. It grows tax deferred, you paid with after-tax dollars, so the cost basis cannot be taxed again, but the interest is taxable at distribution. But under qualified, it's 100% taxable. And we just talked about that free look period. If it was directed, it's account value. If it's not directed, it's all premiums paid.
Right.
Remember, there are surrender charges with annuities, so you have to be very careful and use suitability standards. And look, we saw this one, outliving financial resources. It creates and systematically liquidates an estate. Keyword for an annuity is liquidates, right? We have fixed, which is guaranteed. We have index, which has that floor and the cap.
It's accumulate and systematically liquidate. That's the one out there.
That's the one, yeah. Variable has no guarantees. If you see the word accumulation units or annuity units, that's a key for your variable. Okay.
Okay.
So that's some keywords for our annuity board. We have, again, 8 to 10 questions on annuities. It's where a lot of people struggle is on that annuity board. Remember, if you put in one payment and it begins payout within 12 months, that's your single premium immediate annuity. Not to be confused with the single premium deferred annuity, which is
BDA.
one single premium and the payment will come out at retirement, right? Or flexible premium deferred annuity. If the annuitant dies during the pay-in phase, it's paid out to the beneficiary. If they die over here, depends on what they chose. What settlement option did they choose? If they asked for that 10-year period certain, that means 10 years is guaranteed to have a payout. They die after 5, the annuitant died, 5 years goes to their beneficiary. That means 60 payments, okay? What is it based on? Age, how much money they put in, their gender, the disposition of the proceeds, and the insurance company uses a longer lifespan to make sure that they don't run out of money, right? All right, let's go back to this. So we said the the income was 8,000, that was half, so it's 4,000. What kind of financial product systematically liquidates?
Yeah.
Qualified
You
annuity.
said the keyword is annuity. You see
Mhm.
liquidates, that's an annuity.
Mhm.
Ah, they got you on that one. Ayan, you're in trouble. All right, let's go back up and finish this one. A variable annuity is purchased by a senior and cancels during the free look period. Premiums invested in money market. Which of the following is true?
Paid premium minus.
Paid premium minus the account fee.
Whoa, Jackie, you just said. Yeah, but guess what? Guess what? The right answer is premiums paid, period. But that's not a choice. So now you have to go and say minus account fee. That's going to be the best answer. Unfortunately, it's not the right answer, but it's the next best answer. Now be
Mhm.
careful if it says that's money market. If it says the money was put into a mutual fund, now it's account value.
Minus
But if just account value is not a choice, you got to go for the next best, which is account value minus account fee. Make sense?
Yeah.
A life annuity with installments, certain pays the annuitant when what?
For
For a
specified-
specific minimum number of years or the rest of her life until it goes longer.
Yeah, so if I ask for a 10-year period certain, they're going to give me the minimum of that or pay me until the day that I die, whichever is longer. Make
Mhm.
sense?
Yeah.
Oh, crap. When a life annuity with installments will pay for a specified minimum number of years or the rest of, well, what's this over here? Oh, sorry about that. Let's just pause that. I'm not sure what happened to that question there. The fundamental rule of an annuity is which of the following?
The longer the life expectancy of annuitant, the lower the payment.
That makes sense. If I start getting my annuity to pay out at 25 years old versus 75 years old, my 75-year-old will get more income. Make sense? In an annuity, which annuity option does the company guarantee the least?
Straight line.
Straight life annuity.
Yeah. Regarding annuities, one of the following statements is false. Which one is it?
They are sold to create an estate.
They're supposed to liquidate.
Liquidate estate.
An annuity that pays for as long as the annuitant lives is a
The above.
All of the above.
keyword. Keyword, life, life, life. See that?
Mhm.
Don't worry about that one. Ooh. An annuity that pays income to two or more annuitants until their deaths. It's
A
called,
joint.
A joint and survivor annuity.
if it says it stops when one dies, that's your joint life.
That's joint.
Remember?
Yeah.
Yeah. An annuity that may be used to help fund retirement in a few years maintains a separate account. The owner purchased accumulation units. This is,
Variable separate account is the key word.
yep, separate account variable. The following are true about life insurance policies and federal income taxation, except,
Annuity death
Annuity
benefits.
death benefits are totally exempt from taxation.
make sense?
Yeah.
I don't know why this one is acting up. Oh, that's okay. We lost all the questions. That was crazy, huh? Okay. Let's just give Jackie a hard time today. A man has been diligently investing money for his retirement. His total payments into a tax-deferred annuity are 100,000. He's now ready to take it out. And the insurance company that issued the annuity guarantees an annual payment of 8,000 for the remainder of his life. His expected payout over his lifetime is 200,000. How much each year will be taxable?
4,000.
Ooh, that ends it. That's the annuities. How are you feeling? Good or good?
Yeah.
Yeah. Do you remember the premiums conversations? There's only a couple of them. You want to do them real quick?
Like 8 of them.
Yeah, we can.
All right, not just a couple. I mean, there's more, but for her test. Premiums on life insurance are
Non-deductible.
when the death benefit is paid as a lump sum to the named beneficiary, the benefits are
Non-taxable.
life insurance premiums paid for personal needs are
Non-deductible.
when the death benefit is paid as a lump sum, the benefits are
Non-taxable.
you see how they're playing with you.
Mhm.
in a group life policy with a death benefit of more than 50,000, which is true.
Premium cost.
Premium cost for insurance above 50,000 is taxable income to the insured.
Remember, it's also the way they say that it's added to your gross income.
Mm-hmm.
4 questions on your test on illustrations. Want to prepare?
Go for it.
All right. Every insurer offering individual life insurance policies or annuities to seniors that use non-guaranteed elements in the illustration must provide a statement to that effect. Which of the following is true?
Guaranteed elements must be in bold print and non-guaranteed elements must be in plain print.
Word for word on your test right here. Okay.
Mhm.
Life insurance illustration showing premium values, credits, or charges that are not determined at issue demonstrate.
Non-guaranteed.
Thank you. When an insurer presents an illustration for life insurance, all the following are prohibited except.
Using the insurer's discipline current scale in the illustration.
Thank you. Which of the following is true regarding a regular IRA?
Deductible contributions
Deductible.
taxable.
Oh, yeah.
Okay, Nicole, go ahead.
Deductible contributions, taxable benefits.
Remember, when you say it, you own it, it's yours. So make sure you say it, okay?
Okay.
Every insurer offering individual life insurance policies or annuities to seniors that use non-guaranteed elements in the illustration must provide a statement to that effect. Which of the following is correct regarding this statement?
Guaranteed elements must be in bold print and non-guaranteed elements must be in plain type.
Thank you. Life insurance illustrations showing premiums, values, credits, or charges that are not determined at issue demonstrate what?
Non-guaranteed elements.
When an insurer presents an illustration for life insurance, all the following are prohibited except.
Using the insurer's discipline current scale in the illustration. Excuse- Oh, excuse me.
We just got a couple more here.
Okay.
You need some water? Some water? You good?
So
All right. Rules regarding life insurance policy illustrations are intended to ensure all the following except.
ensure that the illustration specifies that both guaranteed and non-guaranteed elements will continue unchanged for all years shown.
Thank you.
Excuse me.
Last one, if an insurer indicates that an illustration will be used, they must do which of the following?
Send a summary status report to the policy owner annually.
Awesome. We got through in a textbook of 14 chapters. We got through 5.
Okay.
Chapter 6 is a little bit of life right here. Has some really good stuff in here. It's a lot of questions though. Keep your eye on the plan. Your eyes will see it. Keep your eye on but this one has a lot of questions actually. Look at that.
This is going into medical expenses.
Chapter 6.
Right.
It's a mix of group life and group health. Yeah. Because COBRA's there, self-funded is there. There's a lot of questions on this one. There's that 50,000 right there. Key person insurance is right there. Yeah, there's a lot.
What's that one? By adopting self-funded health plan, an employer will have greater flexibility in all areas of planning except claim severity. I don't think I've seen this one. I mean, maybe in the playbook, but like in our
Not in the cram course. So the claim severity means, like, let's say an employee has a catastrophic illness, they have cancer. So that self-funded plan, that's why they have that stop loss contract, because what if they do have an employee that has a catastrophic illness? So the answer would be claim severity. Yeah. Which of the following is true about contributory group insurance plan?
No, that's one employee pays part of the premium.
For words move, they say under contributory, employee pays. Under
Yeah.
non-contributory, employer
The
pays.
employer pays, right?
Yeah. The group medical plan that applies when a claimant has coverage under more than one plan is known as,
Coordination of benefits.
or COB. Identify the statement that is true about contributory group life insurance.
Same thing, the employee will contribute to the premium payments.
What is the purpose of key person insurance?
That's for the business, to indemnify the business for loss of earnings due to a death of a key employee.
Yeah. What is the purpose of key person insurance?
To cover decreased business earnings due to the death of a key employee.
In group life policy with a death benefit of more than 50,000, what is the case?
The premium cost for insurance above 50,000 is taxable income to the insured.
Group life insurance, employer pays premium up to a certain amount. The employees have an option for additional coverage on a voluntary basis.
And
What
the
occurs in these?
employee pays.
Well, that was,
You okay?
yeah, that was contagious.
Is that contagious too?
It is tonight.
Right?
Which of the following statements concerning the usual coordination of benefits provision is correct?
When the plans both have the provision coverage of as an employee primary to coverage paid to dependents.
Alrighty. All the following are true regarding group insurance except
The employer helps the underwriting and risk selection. No, it's not true.
all right. When the employee no longer has to make payments after he has paid his deductible and co-insurance share, and the employer pays 100% thereafter, this is referred to as
Stop loss.
out-of-pocket maximum is another way. In non-contributory group plans, how many eligible employees must be covered by the plan?
100%.
Good job. Individuals covered by the group plan must receive what?
The certificate of insurance. And then the business does the
Master policyholder.
master policy. Yeah.
If premiums for employee group life insurance are paid entirely by the employer, the minimum percentage of eligible employees required to be covered is
100%.
the same thing, just a bit differently. In a group plan, a dependent child attending an educational institution may be covered until what age?
Age 24.
Good job. But what if they're incapable of self-support
Any age.
or indefinitely?
Mhm.
Which of the following is not covered by CLAHIGA?
The
Stop one.
stop loss.
Look at all the following are covered by CLAHIGA except,
Employer self-funded plans.
remember, because it's not insurance. These two, the group stop loss goes with that self-funded plan.
Mm-hmm.
Ooh, the federal law known as COBRA does which of the following?
Allowing for providing protection of ex-employees as well as their dependents by providing them the same conversion and extension benefits for group health insurance benefits as those given to existing employees.
And we talked about this, right? The extension of group benefits.
And that's up to, is it 60 days?
60 days to opt in.
Yeah.
In a group life plan, unmarried children may be covered as dependents until age.
20.
What's the minimum number of employees for group life in California? All, which of the following is not excluded by group life?
Accidental injury.
Good job. Joe and Nicole are married. Bill works for ABC and has health insurance with TIGE Insurance. Nicole works for Exron and has health insurance with XYZ Insurance. Which of the following is true?
In of the event of Nicole's illness, Joe's policy would be excess over anything that Nicole's policy would not pay.
So for spouses, your policy, look at Nicole, you're on the test. Your
Mine.
policy is primary to you. Your husband's policy would be secondary. Now, when it comes to the kids, remember they use the birthday rule. Okay, we
Right.
just saw claim severity, so we won't do that again. Oh, another claim severity. So you can see it's claim severity. You see it, it's the right answer. We saw contributory employee pays, coordination of benefits we saw. This is very similar. We said any age, but the answer here for dependent, that's disabled.
Mhm. For as long as the condition causing the disability continues.
Sometimes they'll say until they're able to care for themselves, right? This is important. All the following qualify for self-funded health plans except,
Individuals.
yeah, we don't want to help self-fund our, we don't want to self-fund our health plan. That's too expensive.
I do have one that I get mixed up on if I could ask it, and it's probably way off, but
Yeah, good.
Medicare, the funding of Medicare is funded by federal and state.
Oh, Medi-Cal, Medicaid.
Medi-Cal is federal and state.
So-
Medicare is only federal.
Yes.
Okay.
Yeah.
Okay.
And then let me show you the boards too, so you can get that in just a minute. So again, for self-funded, except individuals, okay? COBRA, what, if an employee who has a group policy leaves his job, what type of health insurance is guaranteed to him?
Cobra.
Cobra. We said group health is 2, or sorry, group life is 2.
Mhm.
We said when you have COB provision, when both plans have the provision, coverage as the employee's primary coverage to dependents, we talked about that.
Mhm.
The example of a third-party administrator is,
An outside organization that processes claims for employees, employer self-funded plans.
right, that's important. California participation required for contributory plans.
75% of eligible employees.
Under COBRA, a qualifying event ensures that an employee who loses coverage can do what?
Elect to continue coverage.
Self-funding employee benefit plans may include all the following except
Life insurance benefits.
in a group self-funded health plan, the third-party administrator handles all of the following except
Policy owner premiums payments.
a self-insured group qualifies for stop loss claims when which situation occurs.
The specified limit in a certain period of time has been reached.
Good job. In order to join group insurance plan without proving insurability, an employee must,
Join the plan during the open enrollment period.
when a claimant is covered by more than one plan, the situation is resolved through
Coordination of benefits.
in group insurance who are issued certificates of insurance.
The group members.
Employees, group members, same thing. Which of the following is true regarding participation in a non-contributory group health plan?
It must cover all
Must
eligible members.
cover all eligible members / employees.
Yeah, I remember that employer is required to do that. All right, an insurance company pays claims after a self-insured specified limit has been reached. This is an example.
Stop loss coverage.
Thank you. Under the Consolidated Omnibus Reconciliation Act, COBRA, a qualifying event ensures that the employee who is covered may,
Elect to continue coverage.
again, I don't care how they word it, COBRA is elect to continue coverage.
Mhm.
Under COBRA, which of the following is a qualifying event?
Divorce.
Yeah, we
Divorce.
say when you get divorced, your spouse turns into a COBRA.
Mhm.
A distinct feature of the alternate funding method known as self-funding is
The benefits are tailored to participants' needs.
tailored to the needs of the group. COBRA applies to employers with at least,
20.
who has 2 to 19?
Small businesses.
Cal COBRA. Cal COBRA is 2 to 19.
California.
Yes, Cal COBRA. We are special. We want it all. We make it better. A probationary period in a group health policy is intended for people.
Who joined the group after the
Who joined the group after the policy's effective date?
I guarantee you will be on the test. Let me know if I'm wrong. Which of the following applies to the social insurance program known as Social Security?
Contributions are compulsory for most workers.
Mandatory, right?
Mhm.
Mandatory. All right. Association of industry-specific employers who are joined together in order to qualify for and gain premium advantages in group insurance is
Matt.
a
What does
MET.
that mean again? Is multiple employee trust?
Employer trust, but good job.
Employer.
Yeah, you got it. Which of the statements concerning coordination of benefits provision is correct?
When the plan both have the provision coverage as an employee is primary to coverage paid to the dependents.
I think you should say when both plans, but I'm not in. All right. What type of policy would you sell the employer when he wants to cover an employee who is an integral part of the business?
E-person insurance.
Good job. Type of group insurance in which a type of group insurance is which of the following?
employer, employee policy.
Yeah, good job. This is all not group.
Folks.
Group life insurance, employer pays premium up to a certain amount. The employees have an option for additional coverage on a voluntary basis. The keyword is voluntary, therefore,
Employee paid.
Employee-based premium.
good job. In a group life plan, unmarried children may be covered as dependents until what age?
20.
And minimum number of employees in a group plan is?
2.
Whew, how do you feel?
I always mix it with
I
two.
feel good.
Yeah.
Who?
There's no more retirement. There's no more
Security.
retirement questions, so you don't have to really worry about these. Thank goodness. The only one is going to be Arissa. Arissa, that girl, born in 1974.
Looking for-
And that's
I'm
the
looking
plan
for-
participants and beneficiaries. Or if they
Plan-
reverse it and ask the question differently, then it's plan sponsors and beneficiaries, right?
This one is plan descriptions and benefit statements.
Mm,
For this one, she wants to know what's going to be in her plan, right? 'Cause she's going to get half. And then the other one you were talking about is, yes, plan who's protected.
it's
And
like the
that's for the
employer,
plan
right?
participants and their beneficiaries. But if they if they ask you, right, plan participants and benefit for this one, the standards were created for plan participants and beneficiaries. But if it says
Plan
yeah,
sponsors.
if it says the fiduciary responsibility, now it changes.
Mhm.
If it says that, the responsibility is the plan sponsor to the employees,
Right.
to the plan participants. And that completes half of your test. We finished 37% of the life side, we covered a good amount of the 26% of your code and ethics. The only thing that's missing is the health side that we'll cover tomorrow. But I don't think you're going to need that. I think you've got a lot of information for tonight that we studied, that we reviewed for you. Plus in the class, we covered a lot. I would definitely look at the boards for just a few minutes, maybe tomorrow morning before you take your test.
Okay.
Kind of just to go over this shall and may, right?
Mhm.
The duties of the commissioner: accept, interpret contract terms. He's elected for the people. All these little key points here will help you remember so you can be prepared for your state exam.
And last thing, the one question too, Social Security, who funds that one?
We fund Social Security through our FICA payroll taxes.
So the employer, like an individual or the employee.
Yeah, here's the board for Social Security. Remember, there's 4 benefits: retirement, survivor, disability, and Medicare. And we
Right.
pay for it. We get our 440 work credits. We qualify for retirement, early retirement at 62, full retirement age is 65, 67, or your birth is the best answer. Right?
Okay.
Survivor benefits happen when the worker dies. Children
Mhm.
are covered to age 18 or 19 if they're in high school. Spouse,
And
if they're
spouse can't apply until age 60, right?
if the child is under age 16, then the spouse is covered. If not, then they have to wait to 60. So 60.
Right.
That
Right.
period of time where they're not eligible is called the blackout period.
Okay.
And then you have the disability requirement, and then the Medicare. Irma did a great job on the Medicare stuff.
Mhm.
I might have a Medicare. You were worried about the Medicare? Is that what you were saying?
Not super. I think I'm okay. I just the funding part. I know that they're like they ask those questions and they're like, who's funded by what, like who got federal or state or those questions.
You all set? You're welcome, Cheyenne. I'll see you tomorrow at 6, okay?
6 p.m.
Or 5:45 if you want to come in early.
Thank you.
All right, buddy. Good night. Drive safe.
Thank you.
Say that again, Nicole.
I said I think I remember like in the earlier parts of some of the classes with Irma, she was like saying that they might ask you who funds Medicare or who funds Medi-Cal or Social Security.
Yeah, these are Irma's boards that we have up. So you have the MLR 80, 85. So what time's your test tomorrow, you said?
At 1. So I'm gonna take some time in the morning to go over some stuff.
Yeah, what I would do honestly is you have the notes you took from Irma. She has the videos, right? She lets you listen to
Yeah.
the videos again.
Yeah, I'm gonna go back and listen to the video in the morning. She told me about one today that I could go listen to, and I'm gonna do that in the morning, and then I'm gonna just go over my notes and just go in there and do it.
Yeah, I would definitely sleep in because you've been working all night.
Yeah.
And sleep in a bit and relax and just, really have faith. I know that one thing that got you last time was the mindset,
Yeah.
right?
Yeah.
Not that I want to put this out to you, but if you don't pass this time, you better call us first, right? So you can be in class tomorrow night.
Right.
You don't want to go into your pity party and play that game this time. Not to be rude, Nicole. I just want to be very upfront with you.
Oh,
We're
I
here to
understand.
I would definitely use the 4-round system. I'm going to send you a video too that you could watch. It kind of goes over the 4-round system because remember what happened on Saturday, kind of.
Yeah. Yeah.
She made it a bit confuzzling for everybody, so I want
Yeah,
to make
no,
sure
it's fine.
I get you that video. But I do have, again, I just want to make sure that you have the ability to get some resources. Maybe you can listen to it before you go to sleep. And I
Yeah,
would definitely go to the website and grab these affirmations. So I
okay.
think one thing that's going to help you is really mindset. Remember, 50% of this game is mindset. So take the emotion out of it, breathe. I'm going to talk to you about breathing.
Mhm.
Remember, trust the process. You've been studying right answers. So those right answers should jump. Trust your intuition. It's going to be really
Yeah,
important to trust yourself. Don't overthink it. Remember, words and what they say and dance in the conversation. And you got it.
yeah.
You'll
I think I'm gonna be fine.
And you have my phone number now, so I'd like to hear how you did.
I will. I'll reach out to both of you tomorrow and let you know how it goes.
But me first, okay?
Oh God, you guys are so funny. Remind me of me and my sister.
That sisterly love, right?
Right, for sure. Okay,
All
all
right.
right, cool. Yeah, I'm gonna go ahead and try to get me some rest now, and then I
Yeah.
will talk with you later.
All right. Well, thanks for staying an extra hour and a half. I
Me
appreciate it.
too. Same to
All right. You have
you.
a good night.
Okay, you too. Bye bye.